It's 9 a.m. here in New York City on this Tuesday, December 10th. Welcome to Yahoo Finance's flagship show, The Morning Brief, brought to you by Invesco. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, the U.S. stock rally showing signs of cooling. U.S. equity futures pointing to a steady open this morning. This is after the major averages closed in the red Monday, ahead of two inflation prints this week. Investors will closely be watching what the data means for the Fed, with money markets currently pricing in an 80% chance of a quarter-point cut next week.
Plus, Oracle shares falling this morning by the most in about a year after earnings failed to live up to high hopes from investors who boosted the stock to record highs in recent weeks on bets for its growth in artificial intelligence services. Meanwhile, C3 AI shares are surging this morning after raising its revenue forecast and reporting its seventh quarter of accelerating growth. If pre-market gains hold, the stock will hit its highest price since June of 2023. Still down, though, about 77% from its 2020 peak.
And a suspect has been charged with the murder of the United Healthcare CEO. New York prosecutors on Monday charged Ivy League graduate Luigi Mangione with the murder of United Healthcare CEO Brian Thompson, according to court reports. The charge came hours after Mangione was arraigned in a Pennsylvania courtroom on gun and other charges related to his arrest earlier that day at a McDonald's in Pennsylvania after a worker there told police he was acting suspiciously. Mangione was charged by the Manhattan DA's office with second-degree murder, criminal possession of a loaded firearm, possession of a silencer, and possession of a forged instrument. He is accused of fatally shooting Thompson last week outside the Hilton Hotel in Midtown Manhattan.
U.S. stocks are in wait-and-see mode ahead of two inflation prints this week. And our next guest is saying that two scenarios playing out in the equity market once the post-election sugar high fades. Let's discuss that and more. We want to bring in Adil Zaman. He is a partner at Wall Street Alliance Group. Adil, it's great to have you here on set with us. So talk to us just about how investors should be viewing where things are today. So here we are, not too far from those record highs. We certainly have seen that momentum carry through here post-election. What are those two scenarios that investors need to keep in mind as we look ahead to the new year?
Sure. I think that what we are seeing is that once the sugar rush is over, we think that there are going to be two phases. The first phase is going to be that there's going to be a wait and watch type of an approach where businesses and consumers will want to see how the new policies turn out, how the new tax rates turn out. So they're going to scale back, which will lead to a pullback in the market, in our opinion, in the first half of 2025. And then the second phase is going to be in the second half, where we'll get the trifecta effect: low rates, low taxes, less regulation. And that's going to be pro-growth, which is going to drive up equity markets.
How much of a pullback are you anticipating?
I think up to a 10% pullback could be
a correction,
potentially a correction, yes, because we have gone up so much, and although the fundamentals are there to support it, but a pullback is definitely long overdue.
Just quickly here, there's so much buy on the dip mentality. If we were to see a pullback, what's to say that there wouldn't be enough entrance into the market to actually keep a correction from even happening?
Sure, that's definitely a possibility, and markets are expensive. If you look at the PE of S&P 500, we are trading at historically high levels, and that's not to say that we couldn't continue to trade at historically high level. It's very difficult to time it. I think some of that is going to come into play, especially with so much in money market funds, over $6 trillion. So we feel that we can't time it perfectly, but at some point we are going to get some type of a pullback in the markets.
And then talk to us a little bit more about that rebound that you briefly touched on. So you have that trifecta effect going into effect you see next year. Then what does that rebound look like? How can investors take advantage of that?
I think one of the problems that we are seeing right now is that everyone is so tech heavy right now. Even if you're investing in the S&P 500 index, you're more than 40% in tech. So I think investors really need to focus on reducing the risk in that portfolio so that once that pullback happens, they're not so heavily concentrated, and focus on other areas in the market going into 2025, which will benefit under the Trump administration. So we like financials, we like utilities, we like energy. I think those are sectors that investors should broaden their exposure to.
And so within that, which sector is the most ripe to really take on some of the share that the Mag 7 has really been able to see grow at least on a market cap basis over the course of this year as well, and within the S&P 500?
We really like the financials because, and that's playing out really well. I think there's legs to that because we feel that the Fed is going to stay the course. With this CPI data as well, we think they're going to cut. We think that the terminal rate will go to about 3.25 to 3.5. So banks will benefit from that greater investment banking activity. Also under Trump, we think there's going to be deregulation, which is going to help the banks. So for example, a name that we like, Goldman Sachs, they benefit from investment banking. Their assets under supervision in their wealth management and asset division is $3 trillion, more than that. So that's going to grow as the market goes higher, and that's recurring revenue for the company. You
mentioned energy too. When you see a bit of a bounce back, or what we're expecting to see here in crude, are you talking about the large oil players, or how, I guess, can investors best take advantage of that?
Sure. So we do like the large oil players because, again, sticking with that deregulation theme, I think that industry is going to benefit from that. There'll probably be more drilling projects that are going to happen. So we do like the ExxonMobils, the ConocoPhillips, which from a relative point of view are trading at relatively low valuations and also paying a very good dividend as well.
What does that mean for, and kind of more broadly looking out to some of the earnings growth expectations, what are your anticipations, especially if we were to have to move through a correction in order to see the markets hit some of the targets that the street is already setting forth for the end of 2025 here?
I think the earnings will continue to do well, especially I think the Mag 7, they will continue to perform. Mm-hmm. But like what we saw with Oracle right now, right? These are priced to perfection. So anything less than a stellar report will be led with a pullback in the market. So we think fundamentals are strong. We think the Fed is going to be accommodative. We think generally the economy is going to be in a good place, but nothing goes up in a straight line. So some type of retracement we should see.
Adil, great to see you here this morning. Thanks so much for joining us. Adil Zaman here on Yahoo Finance with us. Well, we're also tracking shares of Oracle this morning, ORCL. That's the ticker symbol. You see it loaded up there on your screen. It's down 7%, taking a hit this morning after the company's fiscal second quarter earnings fell short of Wall Street's expectations here. Our next guest remains neutral on the name. With a $150 price target, Gil Luria of D.A. Davidson, who is the senior software analyst, joins us now. Gil, great to see you. Just want to get your overall sense and read through here on Oracle and why the street is sending shares lower here this morning.
Yeah, Oracle has been promising for a while that they're going to accelerate to double-digit revenue growth. And while that may still come, they keep pushing that out. They grew single digits again. And let's not forget, for Oracle, it's a mix. They're growing the cloud businesses very fast, but about 60% of their business is still declining. So it's a cloud transition story that should be accelerating. It hasn't quite yet. And then the other very notable thing is that their CapEx is going to double this year. It's going to be more than 25% of revenue is going to go into CapEx. So the very, very high investments that are not yet translating to revenue acceleration.
Gil, do they need to ink more of these types of larger deals when it comes to Meta? There was a lot of excitement surrounding that, but it seems like, at least looking at the quick reaction here this morning, maybe we're not going to see that big of a spike, and there's more pressure to ink similar sort of large size deals here in the future.
So Oracle has large deals with most of the hyperscalers and Meta, really for spillover, right? The mega caps, Meta, Google, Amazon, Microsoft, are having a hard time building data centers fast enough, and so they're signing these spillover deals to Oracle because Oracle has been very efficient at building out these data centers, and again is doubling its CapEx spend in order to do that. That's good news in the short term. That means Oracle is going to get these big chunks of business. But if you look a little past the horizon, you start worrying about the fact that when those big players have their data centers built out, they may not have as much spillover for Oracle.
Gil, I had a little bit of a drinking game going with this earnings call, and, I ended the day pretty sober because I didn't get any mentions of nuclear reactors, which I've been geeking out about a little bit here over the past couple quarters. There were no mentions of that, but what more broadly do you think some of the CapEx that they're talking about, even if they're not mentioning nuclear reactors in this most recent earnings call, where is that CapEx really going to be thrust towards, and what is the return on that investment and the timeline that analysts and the street should be grading Oracle based on?
Yeah, that's the right question. So building out data centers is very hard. There's the element of getting the land, getting the energy deals, and then you have to build this data center, at which point you put in the servers with the chips in them. That's a long lead time business. And since there's such a competition for that land and those energy sources, we are running out. So we will need alternative and new energy sources. And it's become very popular these days to talk about small modular reactors and how those are going to fill the needs. The thing is, those take many years to build. And so even if we decide that we're going to build a lot of small modular reactors, we're many years away, 4 or 5+ years away from getting those online to power those data centers. So for now, we have to make the most out of existing energy sources, which is one of the bottlenecks to the build out of data centers.
Gil, what about the TikTok situation here for Oracle? We didn't get much commentary at all, actually, about that when it came to the conference call. How big of a hit? What ultimately does that mean for Oracle here in the longer term?
They haven't quantified the size of TikTok, but given what we know about TikTok and their volumes, they might be Oracle's largest customer, or at least one of the largest customers within that Oracle Cloud business, which is the business that's really dragging all the growth behind it. So it could be a pretty decent hit if they lose that TikTok business. What they're saying is, no worries, we have the demand for that data center capacity that we can fill in. That's why growth hasn't accelerated yet. But either way, if that revenue goes away, it'll go away quickly if TikTok is banned in the US. Then, yeah.
Gil, sorry to jump in there, but I guess how confident are you that that's actually going to play out that way? Oracle might be saying that it is confident that they are going to be able to substitute some of that loss in demand, but how realistic is that?
It would take a while. There'd be a gap. There'd be a 1 quarter, maybe even a 2 or 3 quarters of a gap between when they lose the TikTok business, which again could be as early as January, and when they fill it with new demand. So that would be a hit to them. It would be a benefit to Meta, Google, and Snap, but it would be a hit to Oracle.
Gil, it seems like the word agents is the, at least ERP or CRM landscape's favorite new word when it comes to AI and how they're going to be going out to their customers here. For investors trying to figure out how they continue to monetize that and then the pricing power, how long of a runway do you think they have in this pricing power for a lot of the agents that are being talked about at this juncture and really just being experimented with at this point in the cycle?
Yeah, for now, that term agents is mostly marketing fluff. These tools one day will be very successful at helping us automate tasks and carry out tasks for us, eliminating a lot of manual labor. We're pretty far away from that. Right now, we only have anecdotes and niche use cases that are pretty limited. So for now, it's a lot of marketing fluff. Really what we're saying is, instead of a co-pilot, something that, let's say, pre-populates an email for us before we edit it and send, we're talking about tools that will read our emails, write the response, and send it without us ever seeing that. I'm pretty sure I'm not comfortable using that kind of tool yet. I'm pretty sure most people in most companies are not comfortable doing that. So for now, it's mostly marketing fluff.
And Gil, looking ahead to the rest of the week, we're also going to be hearing from Adobe. We'll be hearing from Broadcom. I guess how much of these themes do you expect to be carried through to those reports, or when you take a look at those businesses, specifically Broadcom, some of that outperformance we've seen there, is that going to maybe buck some of this downward pressure?
So I'd say expectations from Adobe are pretty reasonable. They just need to execute, continue double-digit growth, continue a little bit of margin expansion, and there should be some relief there in a similar way that we saw from Salesforce when they reported. For Broadcom, a lot of the story is that the data center build-out a lot of it has to do with the custom chips that Amazon and Google are making in order to populate these data centers, and Broadcom is helping them with that. So they are actually helping with the great data center build out, and they should continue to benefit from that, especially since Amazon and Google aren't getting enough NVIDIA chips. So they really have to fill a lot of that demand with their own chips.
All right, Gil Luria, as always, thanks so much for taking the time to hop on with us here.
Thank you.
Luigi Mangione, a suspect in the killing of United Healthcare CEO Brian Thompson, was charged with 5 crimes, including murder in New York late Monday night. Mangione's arrest ended a 5-day manhunt that spanned several states as the industry continues to grapple with the fallout of the shock of the killing. Now, the executive's death also brought to surface long-lingering frustration within the U.S. healthcare system. Joining us now for more on this is senior health reporter Anjali Khemlani. And Anjali, I know you've been following the story very, very closely. So now they have the suspect here. Just talk to us just about the industry's reaction to this and the headwinds that continues to face the industry in light of these events.
Yeah, I think if you take a look at the stocks, first indicator, of course, for our audience, we see that the stocks remain under pressure for all of health insurers. The biggest ones are still sort of flat. They did bump up a little bit on the news of Mangione's arrest yesterday and still continue to kind of wait and see what the rest of the fallout is. I think if you look at what the maybe commentary from the industry is, the silence kind of is deafening. I think aside from sympathy notes and changing, the taking down profiles and headshots of executives, we haven't seen any of the large insurers really comment on what could be the motive. And that's because we're in a position where there's more questions than answers. We still don't know the motive of the killer, and we are still waiting on more answers on why he specifically targeted United Healthcare and Brian Thompson specifically. But we do know that some longtime experts in the industry, like Oscar Health's Mark Bertolini, who's also the former Aetna head, did say that the shooting was, quote, a wake-up call for the industry. We also know that he said that while the act in and of itself is unconscionable, the behavior of the American public and reaction to it is understandable, given how frustrated people are at the state of the healthcare system in the United States. And it's important to note that this is sort of the question that may be, and the conversation that may be happening in boardrooms right now. It may just still be early days, going back to the more questions and answers. Is the industry going to focus on claim denial, which has been a topic of conversation following the shooting? Or will it continue to defend the system? Because the industry right now is pretty convinced that claim denials are low and that they are finding fraud, waste, and abuse in the system, whereas we know the public reaction has been largely different from that. And so those are the questions the industry is grappling with. It seems like in addition to that, the pylon of a new administration coming in and policies that could affect what's happening, all of that is in the mix, actually, as part of this conversation to see where the industry goes and what kind of decisions come from it, if anything changes at all. It's more of a historical, hindsight 2020. Is this going to be a pivotal moment for the industry, or is it going to continue status quo?
What is the likelihood of that we see such a flashpoint like this and the public outcry there afterwards as well, or at least the public discourse elucidate how so many consumers are also thinking about these companies too and publicly discussing them now too? Does that initiate any major change from what we can see thus far?
It certainly initiates conversation. Yeah. The conversations are happening. Whether or not they are going to simply come out and say, listen, the system is just too nuanced, here's a way to understand it better, here's why you think or feel that you're not getting the care you need, or will they try to work on a system? Mark Bertolini also told me yesterday that no one really has the technology to adequately process claims the way that needs to happen in order for it to be less of an issue and less of a burden. So there are smaller players, right? Oscar Health is one of them. You've got the Scans of the world. There are smaller players in the industry that are doing things differently, but because they don't have the market share, we may not be seeing the impact of that just yet. And so all of that, along with what the trade groups are currently discussing and talking about, is part of what I'm going to be watching to see whether or not this turns into a flashpoint, or does it just become a moment in history and forgotten?
All right, Anj, thanks so much for breaking down the latest, just the impact here, more broadly speaking, to the industry at large. And we, of course, will check in with you as the story develops. All right, we will have much more coming up on the morning brief. We'll be right back.
You're watching the Morning Brief brought to you by Invesco. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. All right, first up, we got a little Taiwan semiconductor sales rising 34% in November. That's boosted by continued AI demand. The chip maker also posted revenue of about $8.5 billion. And then, of course, another stock that we're watching in the chip space as well, Micron Technology, securing a more than $6 billion subsidy from the U.S. Department of Commerce to help build several semiconductor factories there. So we're also tracking shares of Micron in tandem here this morning with the broader chip makers. That is up by about 2.75%. Let me just briefly go back to TSMC as that revenue did jump 34% here. One of the other major items within this is where analysts are hoping that sales continue to grow for the current quarter. 36.3% is the figure there. And so going forward from here, it seems like there's even more of this momentum that TSMC, at least in this near term, is going to be able to ride, even though we're taking a look at shares. I believe that's yesterday's performance. We might be looking. Oh, this is extended hours. Okay, cool. Well, Taiwan Semi still seeing a bit of a pullback here.
Yeah, when you take a look at the reaction here to this, I think a lot of it was just exactly how this is going to play out and what demand looks like going forward. Going into this, when you take a look at how far this stock has come since the start of the year, you're looking at a stock that's up about 80% since January 1st. And there has been some questions or concerns, I should say, maybe just about the data center building, the fact that it is going to slow, what ultimately means for Taiwan Semiconductor. But year to date, actually, those gains up to 91%. So investors are growing a little bit concerned just about whether or not the spending is going to deliver returns, what exactly that's going to look like for appetite within the tech sector for continued AI spending. But again, TSMC, when you take a look at these sales numbers, did rise 34% in the month of November alone. When you combine the sales for October and November, rising 31%, slightly below what the street had been forecasting. So that maybe explains maybe some of the pressure here on the stock. But again, TSMC, very important player to AI adoption. And then quickly, when you mentioned the Micron news there, Brad, and I think that's significant because we've seen the Biden administration doubling down, doing all it can to fuel manufacturing here in the U.S. for chips. They now finalized a series of subsidies that includes $7.86 billion for Intel, $6.6 billion for Taiwan Semiconductor. We got the news here of Micron this morning. We're seeing a bit of a movement here to the upside for shares of Micron, up just over 2.5% here in the pre-market. So again, just more so doubling down on what we have heard from the Biden administration. This is going to fund factory projects in New York and Idaho and is expected to create at least 20,000 jobs by the end of the decade. So again, a stock to watch here.
Yeah.
Let's stick with tech and AI. Google unveiling a quantum chip that it says can solve a computing problem in 5 minutes. That would take a classic computer more time than the history of the universe. Google saying the chip known as Willow paving the way for a large-scale quantum computer. We're seeing the reaction play out here this morning, I think, because we're getting a little bit more substance from the street and what ultimately this means here for Google, for Alphabet going forward. So we are looking at a pop of just about 4% here in early trading. When it comes down to ultimately what this is going to do for Google, how big of a player it could be in the space. I was going through some of that reaction, and basically they're looking at this, and when I say they, many of these analysts, as a breakthrough here, just in terms of the fact that it suggests that the company's chip advantage on the data center side with its own TPUs is likely to expand versus some of those other large tech companies. And we know that Google's cloud segment revenue growth is already accelerating to about the mid 30%, driven by some of that better compute availability here in AI workloads. So with this advancement, maybe we could expect further growth here to the upside.
I'll tell you what, I read this blog post. I just got really excited, really nerded out for math and ultimately the future of compute here. Let's just break this down real quickly here and the significance of this, because it would tremendously reduce some of the computational costs that ultimately are heavily influenced by available memory here. And so that, and their estimates at least, consider a range of scenarios from an ideal situation with unlimited memory to a more practical and embarrassingly parallelizable implementation on GPUs. What does all this mean? It essentially is just chopping down the amount of time by, a few septillion years, basically, is what they said. This would take 10 septillion years, a number that vastly exceeds the age of the universe to perform prior to this chip being put through the rigor. And ultimately, Willow, we'll see how it continues to reduce errors exponentially, but they're going to scale up from here even more, it sounds like, and it's going to be wild to see exactly what that looks like in the future.
Quite the powerful performance.
Yeah,
I can say it.
It's more powerful than my graphing calculators back in the day.
It's much more powerful. All right, guys, keep right here on Yahoo Finance. We got much more coming up. Opening bell when we come back. We've got about 20 seconds until the opening bell on Wall Street. We are seeing a bit of pressure here, at least for the Dow. You're looking at the Dow on track to open the day off just about 0.1%. You are seeing NASDAQ 100 futures and S&P futures here trading to the upside. A bit of a rebound from some of the pressure that we saw across the board yesterday, and much of the market falling in tandem with some of the pressure that we saw on NVIDIA, the largest player there. But here we are with the opening bell on Wall Street. You're watching Morning Brief, brought to you by Invesco. You're seeing some excitement, look at that, at the NASDAQ and the New York Stock Exchange. You have Alaska Airlines and Hawaiian, the now combined company, ringing the bell at the New York Stock Exchange, updating their guidance here, which is helping drive some of that momentum here in the sector this morning that we are seeing at the open. But let's take a look at the major averages here as we get the first trades of the morning. You've got the S&P in positive territory, up just above the flat line there. You still have the Dow under just a bit of pressure. You've also got the NASDAQ here. It looks like at least we'll hold on to gains here at the open. Russell 2000 is also important to take a look at. We can take a look at some of those small cap names. They're off just about 0.7%. Let's flip over to the sector action, what we are seeing here at the open. And it is a bit of a mixed picture, kind of a continuation of some of the movements that we have been seeing as of late. You got communication services, energy among the outperformers there. On the flip side, materials, utilities, and industrials among the big laggards. Taking a look inside the NASDAQ, I mentioned some of the conflicting headlines coming out this morning, to say the least. You do have Oracle under a bit of pressure following its earnings results. On the flip side, you have some optimism surrounding some of those other names, specifically C3AI, where we will be talking to the CEO, Tom Siebel, later on this hour. Some excitement surrounding those names. Taking a look at the larger cap players, though, on an intraday basis, you do have Alphabet's Google here jumping almost 4% on the heels of the chip news that they announced, or heels of the quantum news that they announced yesterday. You also got Apple and NVIDIA moving to the upside. Let's kick it over to Yahoo Finance's Jared Blickery for a closer look at some of this movement. Jared.
Thank you, Shauna. Well, I'm going to start with the S&P 500. I'm going to show you the last 10 days of price action. This decline that we saw yesterday, well, that was the worst that we've seen in 3 weeks, and it really wasn't that much. And this is, to be fair, the low volatility, low volume time of the year when you don't expect a lot. That's said with respect to some announcements that we're getting CPI tomorrow, and of course that big Fed meeting. But all in all, things have proceeded pretty well for the bulls so far in the month of December. Let's take a look at the 10-year T-note yield. It, along with the dollar, not doing much today. You can see a little bit of a jump there. I'll give you a 2-month chart instead of the 10-day. You can see it's still well within its trend channel, heading to the downside there, so no big development. U.S. dollar index arguably kind of breaking out there, but it's just a low volatility move, so I'm not paying too much attention to it. And I did want to circle back to communication services here. That is a leading sector today, but yesterday it was the worst. And in fact, that was the worst day comm services had in 4 months. I'm going to show you the 2-month chart here, and you can see, well, it doesn't look like much when you put it in context, still well within its trend channel, heading to the upside here, but we'll keep that in our back pocket and take another look at it later. Materials is the worst laggard here. That's down about 0.7%, followed by utilities and also real estate. So some interest rate sensitive sectors feeling a little bit of the heat here. And I also want to go back to Apple, because it is coming off of a record high. It's down about 0.25% today, but it has been marching higher. And I think it's notable because we had so many large cap stocks yesterday that were doing well for the year give back their gains. Meanwhile, Apple surging to a record high. So Apple probably looking the strongest technically among some of these mega cap stocks that we watch. And I also want to take a look at China, because China is coming off, and you wouldn't know it from right here, but coming off the best day it had since that September bazooka stimulus measure package that they announced back then. They're promising a looser fiscal policy and monetary policy for the next year, but that did not last today. You can see there's a lot of red there. I'll just give you the 2 days so you can see, well, over these last 2 days, there's a net up in most of these stocks here. Also got to take a look at the futures, because I've been tracking a 2-day rally in gold. And let's punch that up here. Here we go. Here are these two candles that we see to the upside, and now gold is at about $2,710, $2,711. That is some horizontal, some resistance at that level. We'll have to see if it can break through, but it's a quick distance, quick trip to those record highs if it can, and then you have 2,800, and then of course 3,000 in sight. But not to get too ahead of ourselves, I wanted to close on crypto, but take a look at MicroStrategy, because that is a stock, and I'll put the 1 day on here. MSTR has been a very volatile stock, and see if I can, there we go. This whole action in here has just been one big volatility trip. We've seen a number of bull traps. That's where the stock rallies to the upside only to sucker in new traders and then proceed down. But 375 is emerging as a level to watch. So we will be watching it, Brad.
Jared, thanks so much for the breakdown to begin today's trading activity here. Time now for today's strategy session. Yardeni Research, President Ed Yardeni saying that the S&P 500 could hit 7,000 by the end of next year. So what are the catalysts taking the benchmark index to that level here? Joining us now, let's bring in Eric Wallerstein, who's the Yardeni Research Chief Market Strategist. Eric, great to have you back on the program here with us. Just as you're thinking about some of those catalysts that are really going to drive the S&P 500 to those targets and above 7,000, what is the top driver here that you're sensing?
Yeah, so I mean, we've been bullish all year. I think one of the big drivers that a lot of people have been missing is very strong productivity growth. It's already strong. It's likely to continue growing. We're at about 2.5%, but that gets to 3.5%. Then you're right at 4% real GDP growth. So that's great for the economy. It's obviously great for S&P 500 revenues. It's great for earnings. But productivity growth also really helps profit margins. So we think profit margins are going to rise to a record high next year, and we could be at 14%, 14.5% by 2026. So we were already bullish, but I think Trump 2.0 and then also over easy monetary policy by the Fed just kind of juiced that a bit. We're going to get deregulation. We're going to get a lower corporate tax rate. Those are obviously good for after-tax earnings. So yeah, I mean, listen, the market is churning higher. A lot of people are worried about valuations, but as it stands, I mean, it's tough to not be bullish.
Eric, what's the biggest risk, though, to the call? It is tough not to be bullish when you take a look at the market's momentum, when you take a look at the great research that you've put out, that many of your colleagues on the street, just in terms of that upside and maybe what that looks like going into 2025. But there is a long list of risks that could maybe derail some of this momentum. Is there one maybe that you are watching more closely than the others that you think could halt some of this movement here to the upside?
Yeah, I think the biggest one, which is quite new, is the possibility of a trade war. The Great Depression was exacerbated by the Smoot-Hawley tariff, which led to a real slowdown and drag on global growth. It depressed the global economy. Obviously, things are much different today than they were 100 years ago, but a global trade war definitely could be bad for growth. I'm actually not too worried about it. Listen, we've been through Trump administration before. Things were okay. The economy did pretty well up until COVID. But yeah, that's definitely a risk. I think even some people are worried about less government spending, right? We've had a 6% of GDP budget deficit. If, the DOGE agency or whatever can rein in spending, how much will that impact the economy negatively? We're pretty optimistic, though. I think there's a lot of, fat to trim. I think, Scott Bessent has said a 3% of GDP deficit without really a time frame. That's fine. It's not like balancing the budget. And I think if this administration does get a bit of a weaker dollar policy, whether that's negotiated or by some other means, then they could potentially rein in the trade deficit and then therefore the budget deficit. So, a tariff war is definitely the biggest risk because the possible outcomes are so negative, but I don't think that it's, highly likely. Maybe like a 20%, 15% probability.
How strong would the economy need to remain in order for a successful trade and tit for tat type of situation? If that did play out, the economy, it no doubt would need to remain strong in order for the president-elect to feel like he could comfortably go forward with that. What is your estimation as to how the markets would perceive that?
Yeah, I mean, I don't think like a tit for tat strategy on a broad global basis would really work because you're kind of also hoping these tariffs pay for some of the tax cuts, right? So you're going to get less less trade, and so you're not going to get as much pay-fors. But yeah, listen, I think the economy just wouldn't be that strong in that scenario, but I don't think that's what this administration is targeting, right? You're going to encourage allies and those who align with the US and have more favorable trade deals with them. If you pay for your actual defense spending rather than us doing it for you, then we'll have more favorable terms with you. And it's going to push out some of the more pariah states that have, unfavorable trade practices or depress their own consumers in order to lead with exports, such as China. So again, I think the economy is going to be strong. If the trade war does get quite bad, I think it could unfurl and it would definitely weigh on the U.S. economy. But there's no real signs that that'll happen. Trump came out against Canada and Mexico and already spoke with the leader of Mexico and had Trudeau down in Florida. So I think it's, again, negotiations. I think it's a lot of just getting new deals and making sure that our export sector remains competitive.
Eric, talk to us about, and you and I have spoken in the past just about where things stand with the Fed and whether or not the Fed is maybe a bit misguided, I think, to put it in your words, in the past, in terms of the thinking and where things stand. I'm curious, now with another rate cut likely here next week, would that be the wrong move for the Fed? And how should investors then be thinking about policy into 2025?
Yeah, so I think the most likely reason the Fed would have to cut by 25 basis points is just the fact that the market expects it, right? 90% odds of another cut in December. It would really make sense for them to do it. They don't tend to upset the market. The only way they could basically, reverse that and go with no cut in December is if CPI comes in really hot. They tell Nick Timiraos to put a story out in the Journal that, hey, they're actually considering not cutting. I think what they'll do is cut by 25 basis points, but with a very hawkish rhetoric, which will show up in the summary of economic projections, and it'll come out in Powell's press conference. That said, anything less, and Powell has been really dovish since Jackson Hole, anything less, and I think you get long-term yields rise. I think the market rallies, and then you get the risk that we're just melting up on a valuation basis, and then maybe we get a correction early next year. We're not worried that a correction would turn into a bear market, but we had disinflation, strong real GDP growth, and full employment when the Fed funds rate was 5.3%. Do we really need 100 basis points of cuts after that? I think the Fed should just wait and see how the economy reacts to the already 75 basis points of cuts, the new president, these new potential policies, and they have time to let that play out. But, I think CPI comes in hot. And when you have a really strong labor market and you have too high inflation, it's really puzzling why you keep cutting interest rates.
All right, Eric Wallerstein, would love to get you back here soon to react to whatever we're hearing from the Fed next week. Eric, thanks so much.
Thank you.
Time now for our chart of the day. Let's send it over to my Catalyst co-host, Madison Mills, for a closer look at what we're seeing from Chinese exports there, Maddie.
That's right, Shauna. So we're seeing a huge uptick in exports coming out of China to the tune of 7% increase from a year prior. And this, of course, is coming in anticipation of Chinese officials of those Trump-imposed tariffs coming in with the new administration. You can see here on this chart behind me just the huge uptick right here at the end. And this is the highest level of a jump that we've seen in terms of exports from China since September of 2022. And that was, of course, a rebound that was happening coming out of COVID. So it's very significant historically. The big question is going to be whether or not it's enough for China to front load those tariffs with these exports. We know that a significant portion of the Chinese economy relies on these exports because their domestic consumers are continuing to struggle financially as the COVID recovery lingers on in Beijing. Also, what's interesting is looking at this in the context of that proposed stimulus and the loosening of monetary policy that Beijing officials announced over the weekend here. Will that be enough to shore up the consumer so that they have a little bit more consumer demand to lead to a situation where they don't have to rely on exports so much for financial stability in their economy here? And reminder, the Chinese economy has still been struggling. So big question is whether or not the stimulus measures and front loading any tariff impact is going to be enough moving forward here.
All right, Maddie, thank you so much. Appreciate it. As we head to break, let's get a quick check on shares of BA. Boeing, the company restarts production of its 737 MAX jet last week. This is according to reports from Reuters. We've got much more on this as we continue to watch the shares higher by about 2.4% here on the day. Much more ahead on a morning brief.
C3 AI getting a price target raise from analysts at D.A. Davidson, Morgan Stanley, Piper Sandler, and JMP Securities after raising its guidance for the full year. We initially saw a spike in shares, although soon after the open, we are looking at losses here of just about nearly 10% drop. Joining us now, we want to bring in Tom Siebel. He's the founder and CEO of C3 AI. Tom, there's so much to discuss here. I want to start on the price action. I'd love to hear your thoughts. I know you don't focus probably too much on the day-to-day swings and maybe what we're seeing here right after earnings, but when you take a look at the sentiment, at least initially following these results, versus what we are seeing today, any thoughts just in terms of how investors are looking at this, or maybe what the street is missing in this print?
Well, markets kind of thrash around a little bit, and I think yesterday the stock was up huge, so they kind of thrash around. Bottom line, we had a great quarter. I think 29% year-over-year growth. We finished the quarter with almost $750 million cash. Announced a very, very important strategic alignment with Microsoft, who will be carrying all of our products on their price list worldwide, orderable on Microsoft paper for the next at least 5.5 years. So a huge partnership. Business is good, great partnership. Growth is accelerating. It's up net. The stock will take care of itself. It's a positive story.
Tom, is part of this story too, that's going to be increased investments as a result of the Microsoft partnership, or at least a furthering, I should say, of the Microsoft partnership here. And the company sounds like it's no longer targeting to be cash flow positive for the full year, 2025 fiscal year. When do you see some of these investments paying off in the long run in order to make sure that investors are not ever questioning what the cash flow positivity equation looks like for the company?
Investments are paying off now. They're paying off in growth and accelerating growth. We'll be cash positive in the fourth. We'll be cash positive in the fourth quarter. I expect we'll cross over into cash positivity next fiscal year, but we have thousands, perhaps tens of thousands now of Microsoft salespeople who we need to enable to sell our products successfully, and to not invest in that is simply not rational. And so this is going to result in increased growth, increased market share, increased cash flow in the medium run. And this is an extraordinarily positive story.
Tom, to what extent is it going to increase some of your market share, increase some of your cash flow? Because that is one of the points that analysts are very encouraged about, is this increased agreement here with Microsoft, and what ultimately that could do here to drive in growth here in the future.
Think about it. We're a major player in enterprise AI. We have over 100 products in the space. Now we've gone from order of 100 salespeople in September to order of tens of thousands of salespeople in November, or all around the world, every vertical, every geography. This is huge. This is a growth accelerator, and in the medium run, it will result in massive, I think, revenue growth and massive cash flow. So there's nothing that's not good about this.
You've had a long-term strategic alliance with Baker Hughes. Does this partnership with Microsoft offset what is up in the air as analysts and investors are really trying to get a handle on the renewal of that exclusive marketing agreement?
Well, we have had an exclusive marketing agreement with Baker Hughes in the oil and gas services market. We have a great partnership there. It is hugely successful. Our relationships are great. We've extended that partnership, I think, 3 times. I'll be surprised if we don't extend it again. But let's put this into perspective. Baker Hughes is a $24 billion oil and gas services business with a very small software segment. Microsoft is a $250 billion software company, the largest enterprise software company in the world. So there's really no comparison. I suspect our relationship with Baker Hughes will be renewed. I think the decision we need to make is, do we want to be exclusively with Baker Hughes in the oil and gas services market, or do we want to partner with all the oil and gas services providers? Either way, it's a good story, and our business in the oil and gas services market is quite large.
Tom, as we wrap this up, lots of questions just about product roadmap going forward, how you maintain this competitive edge or the dominance within the space. What does that look like for 2025?
Our innovation has been remarkable, particularly in generative AI. We have scores of solutions in generative AI out there, AI in production. 2 months ago, we were granted the patent by the U.S. Patent Office in generative AI. Yes, C3 has that. So all these people who are yapping about AI agents and generative AI, guys, that's our intellectual property. That's a foundational patent. It's a big deal. So, we've been seeing kind of massive innovation, particularly in generative AI and agentic AI. So business is good.
Just lastly, we only got 30 seconds here, Tom. What do you anticipate will be the prioritization for AI from the incoming administration?
Well, I think it's going to be, come on, with Elon Musk involved. I mean, this is going to be, AI, defense, intelligence, government services, Treasury, Justice Department, Health and Human Services. I mean, AI comes to the, top of the priority list. This is going to be more important than submarines, more important than missiles, more important than welfare. And so we're going to make government more efficient. We're going to deliver government services to more satisfied constituents at lower cost. And so AI comes to the top of the list, and this is good for C3 AI.
CEO of C3 AI, Tom Siebel. Tom, thanks so much for taking the time here this morning.
Thank you.
We've got all your markets action ahead. Stay tuned. You're watching the Morning Brief. You're watching the Morning Brief, brought to you by Invesco. We're taking a closer look at some of the trending tickers this morning, and we're doing it in 30 seconds each. So let's go. First up, we've got eBay getting a downgrade to underperform from hold at Jefferies. The firm citing sluggish profit growth and lower estimates than peers based on a slowdown in ad revenue and an increase in spending on marketing.
Plus, Jefferies downgrading Centene, initiating coverage on Oscar Health with an underperform rating. The team's underperform rating on Oscar Health has a lot to do with potentially expiring government subsidies and regulatory concerns that could hurt both of their earnings. Now, Centene cut to underperform, the only analyst to have a sell equivalent rating on the street.
And finally, UPS downgraded to outperform from market perform at BMO Capital Markets. Now, the firm citing a number of tailwinds, including cost reduction programs, easing inflationary pressures, and increasing productivity. The analyst also says the current valuation makes it attractive to investors. That's an upgrade.
That's an upgrade. That does it for a morning brief at Catalyst. Coming up next. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We are 30 minutes into the U.S. trading day. Let's get to the three catalysts that we're watching this hour.
First up, we break down the Fed's next steps as investors await key inflation reports this week ahead of the central bank's December meeting.
Plus, we will get a look at the state of China's economy and whether its stimulus measures are enough to shore up its consumer.
And we'll get a read on the demand picture for artificial intelligence and also the state of cybersecurity as we sit down with the CTO of Cloudflare.
Let's take a look at some of the market headlines to start the hour, sponsored by Tasty Trade. And the three major averages just about 30 minutes into the trading day. You are still looking at some mixed results here. You have the Dow off just about 0.2%. You have the S&P and NASDAQ moving to the upside. The NASDAQ, one of the big drivers there, is movement to the upside that we are seeing in Alphabet, Google's parent company. Shares up just about 4%. Let's flip over to the bond market. The movement in yields to the upside here once again today. You got the 10-year yield up about 2 basis points to 4.22.
All right, well, we are going to move to the next test for the market rally. That's Wednesday's consumer inflation report. It's seen as the key to the Fed's path forward. Joining us now to discuss, we've got Leslie Falconio. She is the head of taxable fixed income strategy at UBS. We've also got Gus Fauché, the chief economist at PNC. Great to have you both on here. Gus, I want to start with you because it seems that the labor market concerns from earlier in the summer have really cooled off, and inflation and the stickiness of inflation is the bigger concern for the Fed right now. How vulnerable are we to a wake-up call on inflation this week?
I would be surprised if we see a significant acceleration in inflation. The progress has been choppy. We've had a little higher inflation readings over the past couple of months, but I do think that the drivers are going to be for slower inflation going forward. We're seeing slower wage growth in the economy, and then also we should see lower rental shelter inflation as we continue to see rent growth slow, and so that should bring overall inflation down over the next year or so.
Leslie, when you take a look at the moves that we've been seeing in the bond market, we got the yields right around 4.2. You take a look at this assessment, really what we just heard from Gus, just in terms of some of those expectations moving forward. I'm curious what your assessment is just in terms of where we stand today heading into the new year.
Well, I mean, actually, I agree with what Gus said. I mean, we're looking for, inflation to trend lower, into 2025 as well, for some of the points that he had mentioned in terms of owner's equivalent rent or insurance costs. But the market still has this, surrounding fear about the reacceleration of inflation, really ever since the Fed cut 50 basis points in September. And I think that that has really been the bond vigilante concern, and will be over the next several months. I mean, our expectation is that they cut 25 at their December meeting, and then they cut 4 times in 2025. But the market has really shifted to a much more hawkish sentiment, with only about 60 basis points of cuts priced in for 2025. So we think that's a bit overdone. So we're actually looking for yields to come down in 25, not by a lot, maybe to around that 4% 10-year yield level. But I think that there's just still a lot of speculation and a lot of unknowns heading into the new year that are keep, I think, bond investors a little bit cautious, particularly on the inflation front.
Leslie, it sounds like you think the market is over-indexing on the risk of sticky inflation. What are investors missing?
Listen, I think this has been just like a constant fear because, even in the first quarter of 2024, you saw a little bit of inflation move up. Obviously, some of these policies that potentially can be implemented are viewed as inflationary. We believe that anything tariff related, the Fed looks through as a one-time adjustment. But there's still a lot of policies that, could come in place in terms of fiscal stimulus at the end of 2025. And I just think there's this overwhelming fear about the reacceleration of inflation, because as inflation has come down, we're not near that 2% target, and we probably won't be. And I think what's going to be key to the FOMC meeting is going to be the summary of economic projections, right? Their new sort of outlook on the economy. And the expectation is that more than likely they might increase their inflation expectation. And the market's also expecting them to take out, maybe a cut or something in their 2025 versus what they had in September.
Gus, when it comes to the factor of inflation with tariffs and just how real that factor is, how realistic that is, the timeline of that, and we're talking about it now, it might not come into effect here until 2026. I guess, how does the Fed walk that fine line, addressing it in the back of its mind, but also looking at some of the progress that has been made up until this point?
I think what Linda said is a very good point. Does the Fed view this as a one-time event where prices jump up because of the tariffs and then increase at the same slow pace that they had before the tariffs? Or do they think that the tariffs are going to lead to permanently higher inflation, in which case they need to keep rates higher for longer? My guess is they'll view it as a one-time event, but that's unclear. It depends on the extent of the tariffs and so forth. And so until we get a better sense of what's going on there, we won't really know how the Fed is going to respond to it.
Sticking with you on that, Gus, it's interesting to look at the optimism about the economy and how we've seen this switch in terms of Democrats becoming less optimistic about the path forward in the UMich data and Republicans becoming more optimistic. Where do we net out then in terms of how the consumer is feeling about the path forward for the economy?
Well, we're in a 50-50 spot in terms of the politics. So to the extent that Democrats are feeling worse, Republicans are feeling better, I think they're largely going to offset themselves. What I do think is that consumers are still in pretty good shape. We have a low unemployment rate, although it's up over the past year. Job growth is still good. Wage growth is running ahead of inflation. And when you look at consumer debt burdens relative to incomes, they look pretty good still. There are some households that are stretched, particularly some lower and middle income households. But generally, households are doing well. And then for upper income households, they're benefiting from higher stock prices and higher home values. So I think consumer spending is poised for continued expansion throughout 2025.
Leslie, when it comes to the outlook, there's so many unknowns when it comes to Trump policy. It's not just tariffs. It's a long list of things that could either drive economic growth or maybe halt it to some degree. I'm curious just your overall take on what we know about the incoming administration's policies and how big of a factor you see that being for overall growth over the next 4 years.
I think it's going to be obviously a big factor. I mean, the fiscal side is going to be the dominant side in terms of what they have the ability to do with a fairly thin majority. But I think that people, look at, what Trump policy implementation will be. The first will be tariffs. But, tariffs we have a little bit of a playbook on, given the 2016, 17, 18. But when it comes on the unknowns such as immigration and what that impact might be on, say, real wages rising, or actually what can get through in terms of the fiscal stimulus side, those are really the unknowns. And it's going to be the fiscal stimulus that really, impacts higher growth, hopefully as an offset to some of those tariffs. I think the point being is that right now we've seen, which is interesting, you saw interest rate volatility really spike before the election, and it's just absolutely collapsed. If you look at things like the MOVE index, I don't think that stays at this low level for long. I do think that come to the new year, you're just going to see that volatility, start to move higher. Plus, it's important to remember that whatever implementations are made immediately, it doesn't really get to the economic data until the second half of the year. So while the Fed remains data dependent, you're still going to have this sort of policy implementation versus actual economic results lagged. So that volatility, I think, is going to continue for quite some time.
Yeah, Leslie, I feel like we keep doing this round trip on treasuries where we end the year exactly where we started. And that's certainly happened over the past month at least. Where are you finding the most opportunity in fixed income beyond U.S. treasuries?
Listen, on the Treasury side, and I'll say this, and we've said this before, we're not fans of the back end. Like, we don't like the back end Treasuries right now. We like anything from, say, a 2 to 5 year area. We're sticking more with the high quality simply because there's not a lot of risk premium priced into a 260 high yield. So right now we're sticking with things like agency MBS, munis, those sectors that really were impacted by either higher interest rate volatility or supply. So we're definitely staying with the higher quality, IG corporates, agency MBS, and some municipals that we think will do well in 2025. And it's not that as though we think there's going to be a catalyst in those higher credit embedded sectors. We just think they're too tight.
Leslie Falconio, Gus Faucher, thanks to you both for kicking off with us here this morning. Coming up, we're going to take a look at some of today's trending stocks. We'll give you the news behind those moves. That's coming up next on Catalysts. Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the session. It's all done at Yahoo Finance's trending tickers page. First up, Alaska Air raising its fourth quarter profit forecast on strong holiday travel demand. The company also expecting to benefit from its recently completed acquisition of Hawaiian Airlines. They rang the opening bell this morning. You're looking at gains of just about 14% for Alaska Air. It's not the only airline here on the move today. You also have American Airlines. They got an upgrade at Bernstein to outperform from market perform. The analysts there saying that the stock could actually surge nearly 40%. They cited the positive industry backdrop and the company's new co-branded credit card deal. And this also comes as the global airline industry expects record passenger flows to 2025. The International Air Transport Association saying that the industry stands to earn more than $36 billion in net income with a record of 5.2 billion passengers in 2025. Taking a look at all these reports that are out this morning, plus the update that we're getting from Alaska Air. And it's a little shocking that not all of those stocks are in the green here this morning. We do have Southwest falling just about 0.9%, so not a significant move to the downside. But when we take a look at the demand outlook, what we're hearing specifically from so many of these airline executives, not only this morning, but what we heard from Delta, Sebastian, what we heard from United going back over the last several weeks on their most recent earnings calls, they're very, very bullish in the setup for 2025. They talk about the fact that demand is there. They don't see that demand going anywhere anytime soon. And they're trying to right-size their businesses and really capture the higher end consumer, the millennial consumer. That was a theme that we heard about so many times on the earnings call. That could really have an impact, the generation that could really have an impact on these names going forward.
It's been interesting to see the theme of so many of these airlines sort of pivoting to a higher income consumer. I think what's happened with Spirit has certainly cemented that as a strategy. It's interesting to think about what we've learned from JetBlue as well over the past couple of months here, announcing a program for their higher income consumers. They're going to have a lounge available, was the word that I was looking for, at JFK for those higher income consumers moving forward here. So they're another one of those airlines that have really kind of doubled down on that higher income consumer. Frontier is also one of them, and it makes sense given these kind of credit card deals that have seen success from these other airlines. Southwest had previously reported success in that model, and American Airlines announcing that co-branded credit card deal as well, which is one of the reasons Bernstein, I believe, is liking the stock here.
Yeah, we also have the fuel costs, which are stated to improve or expected to improve here for airlines. And then you pair that up with the fact that it could lead to better pricing power, I think, across the board. That was one of the bullish notes that Bernstein had in their call specifically on American Airlines. So we'll see. It sounds like a lot of people are planning to travel next year, to say the least.
And in higher tickets as well, so it's going to be
pay up for it.
Yep. Exactly, absolutely. All right, well, we're going to move to Stellantis and Chinese battery maker CATL investing more than $4 billion to build one of Europe's largest EV battery factories in Spain. It is expected to start production by the end of 2026. Stellantis says the factory will allow it to offer more high-quality, durable, and affordable electric cars. You can see on your screen here, Stellantis shares up just about 0.7%, so not too huge of a move to the upside, but this joint venture to build this large-scale lithium iron phosphate battery plant in Spain is expected to be a boost to both companies here. The facility could reach as many as 50 gigawatts of capacity, subject to evolution of EV markets in Europe and continued support from authorities. So that's from a statement from both companies, by the way. So that could lead to a challenge for this moving forward if there is any regulatory pushback here. But having said that, we are certainly seeing this investment in EU battery makers continuing to lead to positive reaction on the stocks. And you can see that in Stellantis here, though it has certainly had a challenging year to date amid the broader slowdown in EV demand in Europe. You can see the stock is still down 40% year to date here.
Yeah, and I think when you go forward and when you take a look at this investment, the scale of this investment, what Stellantis is trying to do with this plan here, they're trying to offer the best in class when it comes to credentials in Europe, trying to separate or do anything they can to kind of separate themselves across the competition because of the fact that they have been struggling. We talked so many times about the challenges, not only internationally, but also just here in the U.S., what they have been facing. But when it comes to this plan and what ultimately this could mean here for Stellantis going forward, will enable the company to offer high quality, affordable battery electric passenger cars and SUVs. But I think the looming question out there is what exactly that demand is going to look like. And when you talk about the fact that they do have this tit for tat for tariffs, when it comes to Chinese domestic cars that are being produced, just ultimately what that's going to do for pricing and to what extent that's going to handicap some of that demand. These are all factors that I think analysts are kind of struggling to still figure out and map out here over the next couple of years, as we do have not only changing regulations on an international basis, but also just focusing it here in the U.S. and some of the changes that are expected to come with the incoming Trump administration as well.
Absolutely.
All right, let's turn to the home builder space. Toll Brothers topping fourth quarter estimates, but falling short on its margin forecast. Joining us now, we want to bring in Alex Barron. He's a Housing Research Center senior research analyst. And you say the shift to more affordable luxury is allowing Toll Brothers to gain market share, yet it doesn't look like the street maybe is buying into that here this morning. What do you think? I guess the reaction that we're seeing in the stock, let's start there. Is that justified to you?
Well, I don't know if it's justified, but it's kind of what we've seen so far in the last few earnings reports. It seems like the builders can't do anything right. You know, they do 10 things, 9 are right, and 1 thing is a little bit off, and the market doesn't like it. But longer term, I don't think it's that big a deal to be worried about. If you look at the full year guidance, the company had similar margins to this year. So to me, it's a temporary phenomenon. What's been happening is builders are having to increase incentives to get buyers over the hurdle. And you saw that their orders were up 30%. So that was pretty significant. So to me, I think if you focus on the long-term picture, the company is just fine.
It's interesting, though, given that you talk about the fact that more affordable luxury is going to be a catalyst for some of these home builders. Do you think that Toll Brothers is accurately approaching that strategy?
Yes, you know, a few years ago, or most of my career, Toll Brothers was solely focused on the high-end luxury market. And a few years ago, they started diversifying into affordable luxury, which is basically like move up and move down homes, which is where a lot of the money is at. And since they started to do that, they started to grow their market share significantly along with other builders who were more focused on entry level and move up homes. So I think it's the right strategy. The other thing that they've shifted in their strategy is they've gone from just building build to order homes to now building spec homes. Spec homes allows buyers to basically buy a home that's a quick move-in, and it allows them to tie up the interest rate rather than take the risk of what the interest rate might be 12 months down the road. So both of these strategies have actually helped Toll Brothers gain market share pretty significantly in the last couple of years.
Alex, let's just take a step back. When you take a look at the macro view right now, we talk at length about the challenges facing the housing market, a lot of that having to do with affordability, many of these home builders pivoting or adjusting their strategy as a result. When you see the incoming Trump administration, some of the changes in policy, we haven't gotten too much clarity just in terms of housing, but I guess much of this focus being placed on the Fed and the roadmap that we're expected to see from policymakers there. To what extent will lower rate cuts improve the housing picture next year?
Well, I think if the Fed takes a look at what has happened over the past couple years, I'm not sure that it was their intent to lock up existing homeowners from selling their homes, but that's been the largest negative impact on housing. It's restrained supply because most people who have an existing home with let's say 2 to 3 or 4% mortgage rate, they don't see the point of selling that house for a more expensive house at a 6 or 7% mortgage rate. So most of those buyers, or most of those homeowners, are sitting tight on that inventory rather than selling it as they used to do to buy a move-up home or some other home. And in the process, freeing up entry-level houses for new buyers. But as the Fed starts to lower interest rates and continues to do that throughout the next year, we think that's going to free up some of that inventory, which in turn is going to add liquidity to the market. And in the process, it's going to make homes more affordable. You know, one of the things that the Fed did was make homes very unaffordable in the last couple of years. So as they start to lower interest rates, as they've already started in the past couple of meetings, we think that's going to increase affordability, and therefore it's going to help all homeowners. But the biggest thing that the Trump administration could do in the upcoming years is to focus on how to get rid of the bottlenecks that the government represents for the housing market. What I mean by that is that if they could add more people to help land entitlement get through the process faster, if they could cut through the red tape with the expenses to, allow land developers to get land to market, and if they could also add people to help with home inspections, I believe that that would go a long way towards shortening the build time and allowing more people to afford homes.
All right, Alex, we've got to leave it there. Thanks so much.
Thank you.
Let's move now to some news for a name that is frequently trending here on Yahoo Finance, and that is Advanced Micro Devices. AMD's executive Lisa Su has been named Time's CEO of the Year. Su became AMD's CEO back in 2014 when the share price hovered around $3. She led a complete redesign of AMD's products and has brought the company to new heights. Its overall value eclipsed rival Intel's in 2022. The stock has increased nearly 50-fold since Su took over as chief executive. AMD is now second in the semiconductor industry, only to NVIDIA, which is coincidentally run by Su's relative, Jensen Huang. Stick around, we've got more catalysts right after this break.
Yahoo Finance has been releasing its coveted annual Company of the Year award since 2014. We'll reveal a winner in the following categories: Company of the Year, Surprise of the Year, Product of the Year, and Comeback of the Year. Be sure to tune into Yahoo Finance starting December 16th for the big reveal. Trust me, you won't want to miss this stuff.
Investors skeptical of China's stimulus efforts will get more clarity this week. Officials are expected to outline more detailed policies at the country's annual Central Economic Work Conference that's set to begin tomorrow, Wednesday. Our next guest calling the scope for effective China stimulus, quote, extremely limited. Joining us now is Brian McCarthy. He's MacroLens Managing Principal and Chief Strategist. It's great to have you back on the program here, Brian. So talk to us just about the fact that you see the scope of that extremely limited. What exactly does that mean? How should investors then be anticipating how significant, or maybe lack thereof, not too significant, some of these changes will ultimately prove to be?
Right. So the market was very excited about the Politburo statement we got yesterday. They certainly have talked the talk on stimulus once again, moving from a prudent monetary policy to moderately loose, which was last seen in the wake of the global financial crisis, and talking about a more active fiscal policy as well. So again, they've said the right things, but in the past they've said the right things, they've talked the talk and failed to walk the walk. And I think that's going to once again be the case. The ultimate constraint on any stimulative policy in China will remain the currency. And while yesterday's Politburo statement did express a sentiment of moving away from the overly stability-oriented policy towards something more growth-oriented, that's what they say. If you watch what they do, they seem to continue to be very reluctant to let the market act upon the Chinese renminbi. So they've pegged their currency. Until they're willing to let go of that peg, their actual room for maneuver in terms of stimulus, which would have to involve loose fiscal policy accommodated with loose monetary policy, basically some form of QE, which we saw in the wake of our housing bust in 2008, and which Japan did for many years in the wake of its housing bust. That's just simply not doable at a fixed exchange rate against a strong dollar. So I would like to see some movement in the exchange rate. That would confirm for me that they're finally prepared to walk the walk, which is a risky path. And this continues to be an authoritarian leadership that is, I think, ultimately more stability focused. So again, talk's great, but the actions I see aren't all that optimistic.
Brian, I want to pull up a chart looking at Chinese exports, as you know, up 7% from a year prior, a huge uptick there in that white bar at the end of your screen for our viewers here. You say watch what China does. Well, they're trying to get ahead of Trump tariffs with this increase in exports. Do you think that is also potentially a recognition that their own domestic consumers do not have the strength anymore to push back against any headwinds that tariffs might cause for the Chinese economy?
Right. The real problem is that imports have been consistently negative, which is reflective of very weak consumer sentiment in China in the wake of the housing bust. Of course, the exports are somewhat goosed by front loading ahead of potential tariffs. I think tariffs will be an issue with regards to China next year. So that's something they're going to have to deal with. And obviously their exports are also, running at healthy levels for the last few years, because it's the one engine of growth that they're focused on, really flooding the world with excess supply in autos and a number of other areas to try to keep some growth momentum and some, employment prospects alive in a domestic economy that is beset with the housing bust. The problem is, if you get tariffs on China, or even the threat that tends to strengthen the dollar, it actually limits the scope for easy policy in China, because again, they're dealing with a currency peg against a strengthening dollar in an environment where that one growth engine, exports, are under threat, also the big generator of foreign currency for China. So it's an environment of currency weakness, which actually limits the scope for stimulus. So if they want to do stimulus in that environment, the cost is going to be a sharp decline in the RMB. And again, they just have not shown any willingness to go down that path. That could change, but their behavior in the day-to-day management of the RMB does not suggest there's anything like that on the cards at present.
Brian, I'm curious what you make of the NVIDIA report that we got out yesterday, just in terms of the fact that China now investigating NVIDIA, accusing NVIDIA of some antitrust practices. And I'm curious how much from your perspective of this is a political play versus concern about some of those antitrust issues here with NVIDIA specifically.
Sure, it's tough to say because NVIDIA obviously has become a dominant player in their space. Regulators in both the US and Europe have sort of hinted at maybe looking at some things from an antitrust perspective. So there is presumably some justification there. But I think, coming on the heels of the sort of the last iteration of the Biden chip controls, which were slightly tightened last week, and anticipation of Trump coming in with maybe something more forceful in the form of tariffs, I do think it's primarily a political message. It's consistent with the political message we've gotten since the election here. Xi Jinping at the APEC meeting in November gave Joe Biden 4 red lines, which were meant to be communicated to President-elect Trump. Basically, don't mess with the CCP. We don't want to talk about human rights or Taiwan. Don't do anything to impede our development, and don't think we're going to change our system, which to my mind is a signal that they're not going to be willing to engage in negotiations like they were during the first Trump term. And I'm not sure President-elect Trump will see any point after he negotiated the phase 1 trade deal that China failed to adhere to. So it could be a fairly quick move, right through any negotiation stage to some kind of back and forth with tariffs and then whatever China has planned in terms of restricting rare earths, punishing multinational companies doing business in China and the like. So this could heat up fairly rapidly in the new year.
Brian, 30 seconds. What company do you think is next that China will target after NVIDIA?
I think anybody who does business in China is going to be vulnerable, and they'll get the most bang for their buck with the largest, U.S. companies who can maybe they can create China can create some lobbying leverage through companies like Apple or Nike. And their hope will be they can threaten pain on those entities to try to generate some political movement in the U.S. But I think it's really going to be a tough lift given the really bipartisan nature of the anti-China sentiment that's developed in Washington.
All right, Brian, got to leave it there. Thanks so much.
Thank you.
Coming up, we're talking with Cloudflare about the broader AI landscape and what demand looks like. Stick around, you're watching Catalysts. Artificial intelligence in focus this morning after announcement from Google on its Willow chip, as well as those strong numbers out of TSMC. But still, very high expectations from Wall Street could be a headwind for the sector if the demand can't keep pace. A quarter of all web traffic passes through web connectivity cloud provider Cloudflare. So joining us now to give us his read on the internet at large and AI demand, we've got John Graham coming. He is Cloudflare's Chief Technology Officer. John, great to have you on. I want to start with what you're seeing across your desk in terms of AI demand, this big question from investors about whether the demand is going to keep up moving forward. What does it look like from your view?
Well, there's nothing that says the demand for AI is slowing down. I think what we're seeing is the real growth of actual AI applications. I feel like 2024 was kind of a year of exploration with AI, and things are now actually turning into real applications. So I'm still pretty bullish on where AI is going, and I think it's going to end up being a part of everything we do on the internet.
John, what more specifically does that look like? Just in terms of the timeline, in terms of adoption, the disruption that we could see across industries, how should investors then be thinking about that?
Well, of course, it's very hard to give in technology timelines, and I think we've all been surprised by the incredible speed at which once ChatGPT came out, it grew to such huge user base. But I can point to something which I think tells us where AI is going, which is you probably have a smartphone and you can probably search your photos by keyword like cat or dog or something. That's actually an AI application hidden away in your phone. And I think the future looks a lot like that, AI in absolutely everything. So when you're thinking about it from an investment perspective, what you need to think about is how is AI going to be used within pretty much everything we do on the internet.
And I know that you all, of course, are offering models in your own AI capabilities through Cloudflare, which require chips from the likes of NVIDIA. Just curious how you're thinking about the CapEx on those chips. Have you looked at any of NVIDIA's competitors or maybe trading down to some other chips as you do expand your AI offerings to kind of cost save moving forward?
Well, I think one of the things that Cloudflare has historically done very well, if you think about the CPU market, is not really worry about the CPUs that we're using from an end user perspective. We're very good at managing different types of CPUs, different generations of hardware. And the same thing will be true in GPUs. And so today, obviously, NVIDIA really is absolutely by far the market leader, but we continue to look at other chip manufacturers, other chips that are out there. And I fully expect over the next few years that within the Cloudflare network, there will be a variety of different providers for a variety of different types of models. But all of that will be entirely transparent to an end user who will just say, I need this model to run fast on your network. Please make it happen.
What does that maybe, if we want to extrapolate that just a bit, what does that tell us then about NVIDIA's position within the market then in the years to come?
Well, what I can say right now is that NVIDIA clearly, and everyone can see it, is absolutely the market leader, and I don't expect them to slow down whatsoever. I just think from our perspective, we will end up inevitably with one or two, maybe three different chip providers, depending on the types of models. And when you think of it in terms of everything getting a bit of AI, then I think there's an all boats rise kind of scenario here where there's going to be a lot of chips for a lot of different use cases, and there's going to be a lot of AI out there. So I think there's going to be a lot more demand.
Speaking of that demand, you have your 2024 report out showing that OpenAI was the #1 generative AI service for consumers. Talk to me about the longevity of that foothold in that #1 spot. Given that OpenAI kind of had the first mover advantage, how long do you think they're going to be able to hold on to that top spot?
Well, that's a great question. And I'm very, very bad at predicting things. So it's hard for me to say that. But I mean, clearly, you're seeing right now, OpenAI announced their sort of 12 days of Christmas thing, didn't they? Where they're going to announce a number of things over the next few days. And they just announced Sora, which is their video model. And so I think they have a lot they can still be doing. What's clear, though, is there are many other types of applications. And so while you might have ChatGPT is a very general purpose provider, you do see other things such as GitHub Copilot helping you write code, or Character AI, where you have bots that you talk with, etc., are also part of this ecosystem. So it's not just all about ChatGPT being the one AI provider, but a variety of different types of AI out there.
When it comes to, I guess, the key in terms of that mainstream adoption, or what is it going to take? We certainly, and we started the conversation talking about the fact that how quickly AI has taken off and the advancements that we have seen, and so hard to gauge in terms of the timeline here of technology. I'm curious just how you stack this up to what we have seen in the past, and maybe what that is an indication of the fact that we're still just very much in the very early innings of all of this.
Yeah, we absolutely are. And it very much reminds me of the period after the web browser became popular and people started using the web. There was this incredible explosion of use cases, and it took a while for us to fully understand how the web was going to be used. And of course, now we use it all the time. I think the same is going to be true of AI. We're going to use it all the time, and we're not even going to think about it. As much as we often don't think about using the web, the same thing is going to happen with AI. It's just going to be part of our experience of using the internet and of using computers.
All right, John, thanks so much.
Thank you.
We're going to stick with the conversation surrounding AI, and OpenAI finally releasing its text-to-video AI tool Sora for ChatGPT subscribers. Users can generate videos by just inputting text. They can also animate images and remix already made videos. The question now is what this means ultimately for Adobe, which touts its own AI video features and has millions of subscribers already using its editing software. This is very incredible, this video that we're showing here on your screen. And I think as we take a step back and even just beyond video, just the fact that this marks a very significant advancement just in terms of AI content creation and the ability that we're seeing AI and how quickly it is able to produce videos like this of such high quality, and ultimately the impacts that's going to have and the implications far beyond one name, just like Adobe. Yes, it is one of the names that first come to mind when you see an advancement like this, but also just more broadly speaking, what ultimately means here for the sectors at large and the film industry at large is the ability to do this and do this so quickly.
It's a great point, Shauna, because one of my first thoughts was that I've had access as an editor in my previous work to these kinds of clips at a much lower price point than $200 a month for ChatGPT. But obviously what's cool about it is that it's AI generated. I just wonder whether the capital is going to be worth it for that if you are a video editor yourself working on this and not just someone who's a fan of AI and thinks that it's really cool. But it is just the beginning, and we will likely see more advancement and creativity in it moving forward. I think the other big question is some of the pushback that we're already seeing. The team that was behind Sora, the group of artists who claim to be part of the company's alpha testing program, did leak this product in advance of this announcement as part of what our last guest was saying, the 12 days of shipments that OpenAI is engaging in right now. And it comes amid a lot of questions and pushback against OpenAI about their move to this for-profit model and whether or not the systems like this one are going to be safeguarded from any explicit content or just question marks about the use of this platform moving forward here. Yeah.
All right, well, coming up, we are taking a look at potential buying opportunities in the energy sector. We've got that for you next on Catalysts.
Yahoo Finance has been releasing its coveted annual Company of the Year award since 2014. We'll reveal a winner in the following categories: Company of the Year, Surprise of the Year, Product of the Year, and Comeback of the Year. Be sure to tune into Yahoo Finance starting December 16th for the big reveal. Trust me, you won't want to miss this stuff.
Oil prices steadying, reversing earlier losses as investors weigh worries of a supply glut next year against China's vows for further stimulus. Our next guest sees buying opportunities in the energy sector. We've got Cole Smead. He's the CEO of Smead Capital Management joining us. Cole, great to have you in studio. I want to start on OPEC holding off on that additional production. What do you anticipate that impact looking like next year? Is there any potential for a squeeze in the market?
A lot of the people that report on oil don't come from OPEC meetings. They come from Western journalism, and so therefore they're not sitting there in OPEC discussions talking about that. They're really on the outside of that. So I look at OPEC has been very communicative. They've said, hey, here's the deal, we're going to cut and we're going to maintain. And everyone's like, we'll see. They're very worried about that. The reality is, if you look at OPEC, they haven't been the swing producer for 20 years. We are the swing producer here in the United States. And we've grown production massively looking back that 20 years. The question is, can we, as that marginal producer in the world, continue to sustain? That looks very unlikely. If you go, last week, Chevron was reporting that they're going to pull back $2 billion in CapEx. Well, why would Chevron be pulling back in $2 billion in CapEx if Donald Trump is saying drill, baby, drill? And the reality is because they're not going to waste money unless they get the prices to. And so we're really seeing this match of, there's worry about supply glut, but at the same time, places like the Permian, you're seeing a lot of well decline. And the question is, where will that meet? And I think because the stocks have lost money for 2 years, everyone's saying, great, it's tax loss selling season. If those stocks are going down, what is that telling us about the future? The reality is it's telling us nothing. It just tells us that people have lost money over the last year.
What does that tell us, though, from an investment? I guess should investors be viewing this as an opportunity, just in terms of the fact that they are so cheap and they have been under pressure?
Yeah, wonderful question. So, let's just take the energy business. Let's compare that to the S&P 500, for example. Okay, so I think the S&P 500 produces like 18% return on equity. If you look at the average oil business right now, you can find businesses that produce somewhere between, say, low teens to maybe mid-teens return on equity. Okay, now the question would then be, well, what do I have to pay for those different return streams? You pay 4 times book or greater for the S&P 500, you're paying somewhere between book and a half in the energy business. So you're getting similar returns, but vastly different multiples for that. And I think that really shows you the opportunity in the business, which is that these businesses historically don't produce those returns because they drilled way too much, lost way too much money. That was the story of the 2010s. Now they're really disciplined. And everyone's freaked out. Back when they lost money, they loved those stocks. I don't get it. Today, they're producing these good returns with great balance sheets that they really have never had. And the market's really freaked out on that. I'll mention one other thing. If you look back at 2 other periods, the 70s, which was a terrible time to be a stock market investor, and then the 2000s, as noted by the S&P, it did terrible. Well, you made wonderful money in the energy business, and you didn't really care what went on in the S&P 500 outside that. So to your point, it's incredibly timely. If someone's waking up saying, I find what's going on in the S&P 500 to be very unattractive, I would agree. And the reality is that's a great place to go allocate capital and try to make money in what will be a tough equity environment. But geopolitical problems, do they help you or hurt you? They help you. A lack of supply in the oil business looking 10 years forward because we can't produce as much. Those problems help you. And there's not a lot of things that I can find where I could say, hey, problems help you today.
So what's the trade then? Is it individual names? Is it an index that tracks the sector?
Yeah, I would say if you look at like the XLE, it's a pretty poor way to go do this because it's really holding the majors. So for example, we own APA, Apache is what they formerly were known as. They trade for less than the invested capital in the business, and those are producing about mid-teens returns. So how we look at this as an investor with names like that, Occidental Petroleum, Conoco, up north of the border, Cenovus, is what if in the long run, because these are capital-intensive businesses, they go to book value, which I know is like unattractive to say, but they're capital-intensive. All we're really anticipating is making the return stream, which I call cash, that we accrue and then ask, do we want to pay it in dividends or buybacks? If that happens, our multiples could go down on those businesses and we can make very good returns. That's a vastly different conversation than what if the S&P goes from 4 times book to 3 times book or 4 times book to 2 times book? Will 18% returns make up for that? That will be a lot tougher in comparison. So what are your expectations you have to build in to make money on securities? I think that's a big difference between those names I mentioned versus what you have to do broadly, or even in the XLE. You really got to know that Exxon and Chevron are going to do well in the XLE. And we don't got to know that, right? We just got to go out and find names that fit what we do.
Cool. What does that tell us as we just take a step back and kind of relay the investment thesis there to maybe what that tells us more broadly speaking about the market right now and current valuations and where things stand heading into the new year? You have a new Trump administration. What should the calculus or what should the approach or strategy, I guess is the best way to put this, be for investors heading into the year, given where things are?
Yeah, it's a great question. First off, just in full disclosure, I'm a card-carrying Republican, but I'm also a card-carrying pragmatist and capitalist too. And I say that because everything of Trump, we're at peak Trump. When I say peak Trump, everything that can go right, it's already priced into securities markets. Oh, we're going to save money here and we're going to cut taxes to corporates and all that stuff. It's all priced in. It's completely priced in. Anything less than that's going to be disappointing. That's the first thing I'd say. Secondly, U.S. household ownership of equities has never been higher, as noted by the St. Louis Fed. Foreign ownership of U.S. equities has never been higher. Those bode terribly for forward returns. And so, someone said, I was joking about 75-degree weather in Phoenix, and they said, well, here we live in the real world. And I asked them, is this the real world? And the reality is I don't think it is. Everyone thinks they're going to get rich in the stock market. In comparison, a 10-year treasury paying you 4.2% against these risks looks very attractive. It's risk-free. You know the volatility. And most people are taking way too much risk on the stock market. So to your point, I think it's a wonderful time for people to say, wait, what if too much good things and hopes and dreams are baked in because we're all actually doing the same thing at the same time, which never bodes well for risk taking. And again, the risk-free rate is staring you at a pretty good return relative to our lives, I would argue.
Really quickly, any concerns about policy that could impact the economy and therefore the market, tariffs, immigration?
So I'll give you, Munger says to invert, I think the tariffs will help Europe a lot because ultimately the consumers there are paying way too high prices. By taking tariffs to bring down barriers, you're going to see economic growth pick up in some of these other countries that have been using protectionism to actually hurt their own consumer and citizens, versus here, we don't play those games as often, therefore we don't benefit from those things in the same way.
Cole Smead, always great to have you, especially here on set today. Thanks so much.
Thanks for having me.
Well, that does it today for Catalyst, but keep it right here on Yahoo Finance. Coming up next, it's Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. Stay tuned.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, we're talking to a portfolio manager about inflation expectations and your investments and all the correlation. We'll dig into the stock picks that you can consider for 2025. And attention, all ye job hunters. Indeed is out with its 2025 jobs and hiring trends report. We'll talk about the takeaways with one of the firm's economists who can also share some strategies to land your dream job in the new year. Plus, if you're shopping for holiday gifts, we have you covered. We'll talk to two experts about how you should or should not be paying for your presents, be it with a store credit card or BNPL, buy now, pay later. All that and much more, but first, let's take a look at some of the market action. As we are 90 minutes into the start of today's trading activity, stocks, they're edging higher ahead of November's CPI report. That is due out tomorrow. Joining me now here on set, we've got Robert Pavlik. Bob of Dakota Wealth Management. He is the senior portfolio manager there. Great to have you in studio with us.
Thanks for having me back.
What are your expectations, especially as we are all geared and revved up for tomorrow's inflation data?
I think you're going to see a little bit of an increase in the CPI numbers. They've been trending a little bit higher, which is not, favorable to the Fed. But I think as it relates to the Federal Reserve is probably going to cut interest rates next week. And then I think that's going to be a reason to pause with these slightly higher inflationary numbers. But I think as we go into 25, I think you're starting to already see some signs that the economy is slowing. Look at manufacturing, look at some of the numbers in the employment area. And I think the Federal Reserve is going to be on pause for a little bit. Then they realize somewhere, late spring that it's probably going to be time to start getting into this rate cutting program again.
Interesting. And so what is your forecast and your outlook for the number of cuts and how the markets would ultimately appreciate that or digest that, I should say?
So what I'd like to see for next year is another 1% in total cut. Now, do we get there? I think it depends on a lot. It depends on inflationary numbers. It depends on how the economy is doing. There are aspects of the economy that are doing well enough. I mean, Powell has come out and said that same thing. But whether or not it continues to hold up is the major question. There are questions about Trump's policies. Now, we all know Donald, especially us in New York. We know what he says doesn't always translate into exactly what happens. And so I think you have to take it with a bit of grain of salt. So does that mean interest rates continue to sort of trend up? I don't think so. I think, right now at 423 is probably a number that it should come down from. I think, if we can get to 405 or 4% on a 10-year treasury into early 25, that's actually a good thing. And then I think we could trend down a little bit further later in 25. But I think for the S&P 500, I have 6150 for year-end target this year.
Okay.
But then, because I think the economy is slowing and I think the Federal Reserve is going to be on hold, you're probably going to see a little bit of a give back. And so I could see 58.50, 58.25 by mid-year. But then again, I think as rate cuts come in, as the economy gets a little bit of a boost from these rate cuts, because not all of Trump's policies are going to be enacted, I see 7,000 for a year-end target for next year.
Interesting.
So from 7,000 to from 6150, you're talking almost 14%. So a pretty decent year.
So, and that would be after not an all-out correction, it would seem, for the first half of the year in your outlook there, but an extreme bounce back even off of the pullback that you're anticipating.
Yeah.
What are some of the areas that could be heaviest hit in that initial pullback? And then on the back half of the year, if you will, the mullet trade, as we've heard it talked about in the past, where that could initiate even more interest from investors?
So what could get hit? I think pretty much all areas of the market are going to probably feel the pain under that, getting us to like 58.25 figure. So I wouldn't be freaked out in getting out of the market. I'd use that as actually a buying opportunity. And so what I would turn your question around and say, what areas of the market do I want to focus on? I want to focus on, I think, what's going to work. If we have a slowing economy, people generally try to grow the value of their portfolio. So how are you going to do that? So communication. So I'd look at things like Netflix and Google or Alphabet on any kind of pullback. In the consumer discretionary, I'd look at Amazon, and then I take a look at RCL, which is Royal Caribbean, has done extremely well, but I wouldn't be buying it here. I'll wait for a little bit of a pullback. Finance, I take a look at the money center banks. I don't think the regional banks are going to be sort of doing as well as they have done. They rely too much on demand growth, loan demand growth. So I think the money center banks, and I also would take a look at like an insurance agent like AJ Gallagher. In industrials, I take a look at something like United Rentals, which is getting hit today. But I don't think it's time necessarily to be buying that. If you want to do a little bit of buying into United Rentals now, I would say just add a little bit and wait for a little bit more of a pullback. I'd also take a look at Eaton, ETN, and then I'd take a look in the technology space. And so what I like in technology is Salesforce reported a great quarter. Well, I guess a pretty good quarter, we could say, but very optimistic about their new products. And then I take a look at Arista Networks, ANET, which has done extremely well, demand for servers for the data centers. So those are my areas of the market that I take a look at. I wouldn't be buying it now, but I think you have to make a list. Just like going to the grocery store, you have to be prepared as what to buy.
Right.
So that's what you need to do. You have to be prepared, you have to have a list, and you have to look for bargains when they come up.
Certainly. Bob, thanks so much for taking the time here, laying out some of the bargains that you're going to be watching out there in the markets. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got my morning brief co-host, Shauna Smith here. First up, we got to talk a little AutoZone. You know I love to talk these names here. Reporting first quarter results, we're looking at a profit miss, earnings per share of $32.52 versus an estimate of $33.62. Net sales nearly in line with expectations, and domestic comp also falling short here on the sales front. All right, shares up 2.5%. What do you spot here, Shauna?
So I think a couple things are going on here. When it comes to some of the concerns moving forward, you take a look at the higher material prices. That's obviously a headwind here, a challenge. A stronger dollar can very much be viewed as a headwind here, or at least in terms of, I guess, more overall a risk going forward here for this company. And then you look ahead to 2025. You have the incoming administration, the Trump administration, some of the policies that you and I discuss on a daily basis. Most specifically, the impact that we could see here is from tariffs. And this is a theme that we have heard across not only this sector, but really across various sectors this earnings season. And AutoZone's CEO in the past has come out and said that if we do get tariffs, we will pass those tariff costs back to the consumer and we will pass them through. You might initially look at a statement like that and say, okay, maybe that means that their margins won't be as affected or as hit as hard as maybe initially anticipated. But I think in this macro environment right now, once you do take a step back, you got to ask what that's going to do ultimately here for demand, just given the fact that consumers do remain under pressure. If they are facing higher prices, maybe they aren't willing to go out and spend even on necessary goods and products like cars, that could ultimately really hurt this company here in the future.
Yeah, absolutely here. And I mean, it comes at a time where many people are tracking what their insurance rates and the claims that they may submit and the ultimate remittance of payments for those claims and what gets approved and denied, certainly coming into focus as consumers are monitoring and will be watching for that auto insurance line within the CPI prints tomorrow. That's something that we'll be breaking down for you live. Deep tease. But anyway, more imminently, let's talk a little Academy Sports. They reported third quarter results, trimming the upper end of its 2025 sales forecast. The sports retailer also falling short on estimates for sales and profit in the quarter here. Shares, though, they're up right now by about 5%. So some of the negatives, at least, investors seem to be shrugging off right now.
Yeah, and this is a stock that's been under pressure. When you take a look at the year-to-date chart, shares are off just about 20%. So a lot of the worrisome and a lot of the concerns are very much baked in to the stock price here. It did fall just about 3.7% ahead of the bell, just specifically yesterday, ahead of what we did get with these results. Management did reduce the annual forecast, which of course is a driving factor, the big takeaway, I should say, from this earnings print here for the quarter. But I think looking out, the fact that the company is planning to open 20 to 25 new stores next year, they did authorize a new $700 million buyback program. And then when you take a look at these numbers here, It was a bit of a disappointment, but not a huge miss. You got net sales off just about 3.9% on a year-over-year basis. You got comp sales off 4.9%. Yes, weaker than what the street had been anticipating, but they went into this report with some concerns just in terms of that macro environment, where exactly we were going to see consumers willing to sell. So I think the fact that it wasn't a bigger miss that you did see on the top and bottom lines is almost looked at maybe a bit reassuring here by investors.
I think one area that investors might be looking at is just saying, hey, this company and the executive team are trying to buoy us right now with this $700 million share repurchase program. And I mean, looking at all of the line items that have a parentheses around the financial performance, which means not good because it was negative at least year over year in the percentage change, as the company noted within this, and you called out the net sales decline of about 4%. There were a lot of marks that were to the downside here, but perhaps the executive saying, hey, we need to signify to the street that we still have confidence in the way forward here with and via a share repurchase plan, at least as of right now here.
Yeah, and I think because of that, because of the uncertainty, it's keeping many of the analysts on the sidelines. You had Evercore out this morning saying that they're reiterating their inline rating, their $60 price target, and I think a lot of that just driven by the fact that that there is so much uncertainty. Very much the future is clouded by what exactly these policies are going to look like, how stable the consumer is going to be in the new year, and obviously that has a direct impact on the performance and what we'll likely see in terms of these sales numbers going forward.
All right, maybe I'll have to slide back through some Academy Sports, get some new cleats or something like that.
Have you shopped there before?
No, I haven't
There's
yet.
not many in this area.
All right, so I'll rephrase the sentence. Maybe I need to slide through an Academy Sports and finally pick up a pair of cleats.
Yeah, make a trip out of it.
All right, it's going to be a flight. Ohio is where some of the new stores are opening up, I believe. All right, Shauna, thanks so much. Appreciate it. A survey measuring home buyer and seller confidence shows that consumers are getting used to the tight housing market, and they're optimistic about 2025. Fannie Mae Home Purchase Sentiment Index increased to 75 in November. Year-to-date, index is up 16%. For more, I want to bring in Yahoo Finance's Claire Boston. Hey, Claire, what do we know?
Hey. So we are seeing a little bit more optimism from the consumer about the housing market, and this is pretty surprising. You know, affordability right now is still a huge challenge. Mortgage rates are pretty high, and then home prices overall are near some of the highest levels on record. But what the consumer is telling us is that they think things are going to be a little bit better next year. They're generally seeing mortgage rates that might decline a little bit, and they're not too worried about home price appreciation. However, what I think is interesting here is I talked to a lot of experts in the market, and a lot of them are saying, you know, we think that mortgage rates may not fall very fast next year, and that home prices are still going to rise a lot. So I think there's a little bit of a disconnect here between the consumer and, you know, the more kind of expert economist type.
Interesting. While we have you here, Claire, Realtor.com also released their list and their survey of top housing markets for 2025. And I had the chance to speak with the chief economist, Danielle Hale, about the trends in the South. I want to play this clip and discuss it on the other side.
So in the South, we've seen inventory recover better, and so we expect to see somewhat weaker price performance in some markets in the South. Other markets in the South are going to see stronger price performance, where we've seen a lot of new construction go up, and so a shift of the share of homes that are selling that are existing versus new. So the South is going to be a big mixed bag.
So I just want to know what you make of some of these trends in the regionality that we're seeing here.
Right. So the housing market is always really regional, and I think the South is one of the most interesting places to look. First of all, you have Florida, very messy market right there. We are seeing, you know, real ramifications from that condo crisis and just the rising insurance costs there. And then as well, in other markets, the South is one place where you can still build homes. So they have seen a lot of new home inventory. And in some markets, that is actually starting to push prices down a little bit. You know, it's a real rare bright spot for the consumer there in select markets. That being said, there are other markets that are still very, very hot. Atlanta is pretty hot, Nashville, etc. So it really depends where you are.
All right, Claire, thanks so much. Appreciate the breakdown on the regions that we should be watching going into 2025. Appreciate it.
Thank you.
Coming up, everyone, we're talking all things small businesses. Here's where I'll look from their feelings about the economy to their use of AI. That's next on Wealth. Main Street optimism surged post-election to its highest level since 2021, according to the latest survey from the National Federation of Independent Business. So, why are small business owners feeling so good? Here to discuss is Holly Wade, Executive Director at the NFIB Research Center here. Holly, great to have you on with us right now. What is the biggest change that you've seen, especially as small business owners are really going to be trying to get their heads around what a new administration might mean for small business and what's anticipated as well?
Absolutely. Thanks for having me on. So small business owners, they are far more optimistic these days. The last month, we saw a huge surge in our index. Looking at small business optimism, the biggest contributor to that was the general business conditions. Far more small business owners were saying that they anticipate business conditions improving over the next 6 months, but also increased spending, increased sales at their business. So small business owners were looking for or eager to see a dramatic change or shift in priorities on economic policy. And so they have a lot of expectations going into 2025 on what that looks like for them, as far as tax policy and also the regulatory environment.
So let's talk about some of the tax policy here. What's been campaigned on versus what's likely to come forward? What are small businesses anticipating?
Sure. So the Tax Cut and Jobs Act of 2017 that's set to expire, those many provisions that have been helpful for small business owners, especially that 20% small business deduction that they have been relied on for the last number of years, is set to expire. So we have a year, 12 months for Congress and the administration to extend or preferably make permanent those provisions that's been so helpful. Small business owners were worried about, what the elections might look like as far as tax policy, tax reform, if they would end up seeing a tax increase at the end of next year. And so they're a bit more confident. We saw the increase in the optimism index. We also saw a dramatic decrease in our uncertainty index, which was also a good sign that they feel more comfortable about what to expect going forward as far as some of those more difficult challenges that they were facing going into 2025.
One of the larger kind of announcements that has been starting to get teased from President-elect Trump is around tariffs. And I wonder what you're sensing from small businesses, at least at this juncture, as we are still a little over a month out from the inauguration.
Sure. So as I mentioned, that uncertainty index did fall from its historic high. There are still a few areas of, concern of things that might increase or have inflationary pressures. Tariffs is one of them, but, we don't know what that looks like exactly going forward. So a lot more details need to be kind of flushed out to see how that might impact small businesses. But right now, it's a big question mark, a big unknown about, kind of the degree to which or how broad that might occur and how it would impact small business. So still a lot to be determined on that front.
I'm always intrigued about what the outlook for small businesses, as you and I have discussed before, is with regard to hiring and their own ability to make sure that they have the necessary amount of workers, of employees to really support their own growth as well. What are you hearing there? And then the added layer of what potential deportations could mean, especially with immigration policy, as President-elect Trump has talked about for their own hiring plans.
Sure. So still about 1 in 5 small business owners are saying that labor quality is their biggest issue in operating their business. So it remains a tight labor market for small firms, especially in those industries, including construction and transportation. Those are the two dominant industries that we see in our survey as far as challenges in hiring, filling those very historically high level of job openings still. And again, that is a big question mark about the new administration going forward, is how they, how they tackle immigration policy, what that looks like. But still right now we're seeing a lot of compensation increase pressure as far as increased costs in operating their business to retain and recruit applicants for those positions. So labor is still a significant challenge out there, including inflation. So kind of those two, especially with compensation and prices of supplies and inventory kind of going hand in hand on those cost pressures, but they're still very prevalent in the small business sector.
All right, Holly, look forward to checking back in on future readings as well. Appreciate the time.
Thank you.
Well, AI is in focus this week with Oracle and Adobe reporting quarterly results. And we're getting updated looks at the demand for AI products. Oracle already reporting lower than expected revenue as competition in the cloud space heats up. And we're hearing from Adobe tomorrow after the close, Wednesday. We know big businesses like Meta, Microsoft, and Amazon are spending a lot to build these products, but are smaller businesses using them? 57% of small businesses have at least tried generative artificial intelligence, according to a survey from Gusto, a platform that offers software support for small businesses. And here with more, we've got Nick Tremper, who is the senior economist over at Gusto. Nick, great to have you here on the program with us, and want to dive a little bit deeper on this. What are you seeing the early findings from small businesses that have been kicking the tires here a little bit, or at least trying to figure out how in their own examination or early experimentation that generative AI can help their business?
Yeah, thanks so much for having me on. What we find in the report that we're releasing today is that a significant number of small businesses are really exploring the use of generative AI, right? 25% are using generative AI, another 33% are actually experimenting with Gen AI. They're trying to find the right fit for this technology. But one of the key important findings for me from this report was that businesses that use generative AI really benefit from hiring folks, right? People who use generative AI had a 45% easier time hiring employees than those who did not use generative AI in the last year. And we see this across industry and across firm age, and also, across location. This is something that's happening broadly because it makes people more productive, and business owners benefit from that.
And so I wonder what you're finding among the types of business owners, and perhaps in the generations, and where you might see some differing in the willingness to at least experiment with generative AI for their business. Are you seeing this more among some of the more seasoned business owners, or is it younger business owners that are really tapping into the technology?
Interestingly, we're seeing folks across generations using Gen AI. That said, it's primarily being led by business owners who are Gen Z or millennials, right? They're 56% more likely to say they use Gen AI than their Gen X counterparts, and 76% more likely than baby boomers. And, this is Gen Z and millennials are defined by their proximity to technology during their formative years. These are folks who know how to embrace rapid technology change and how to implement it into their lives. They're native and comfortable in doing this in their personal lives, and are really finding benefits in their professional lives as well as they age into the space when they're starting businesses.
We've talked about AI being used for hiring practices right now. AI and hiring first, but where else in the business is ripe for leveraging this technology, and for small businesses especially to find the opportunity to perhaps mitigate some of the outstanding costs that they've really had to navigate for decades?
Yeah, what we're seeing is that, Gen AI users are really using this technology to enhance and complement their existing workforce, right? So they're using this technology in ways that makes their employees more productive and really able to execute on the job that they were hired to do. A good example of this is, think about somebody who is, hired to be a program manager at a local community theater. We're seeing community, recreation, arts, all these services have increased use and increased benefits from Gen AI. And it's because these folks care a lot about bringing the arts to their community, right? And they can use Gen AI to help them make a schedule and plan out when a dance crew and when a Christmas carol is going to be played this weekend. And then they can focus on bringing the next art exhibition to their community next year. It's really helping folks benefit and grow their own skills and really use the skills that they were hired to use, while Gen AI does some of the other things.
Nick, thank you so much for taking the time and spotlighting how small businesses are leveraging the new technology. Appreciate it.
Thanks for the time.
Absolutely. Coming up, everyone, we've got your Yahoo Finance market update. We'll check out how stocks are moving and run through 3 stories that you don't want to miss. Stay tuned.
We're 2 hours into the trading day and it's time for Yahoo Finance's Market Minute. Stocks edging higher ahead of Wednesday's CPI report. Let's also look at these headlines. Citigroup CFO Mark Mason expects a 25 to 30% rise in investment banking fees in the fourth quarter from a year earlier. That typically signals higher volumes of M&A activity as complex transactions require more time and expertise. And shares of developer platform MongoDB falling this morning despite a Q3 earnings beat and solid growth in revenue and customers. News of longtime CFO Michael Gordon's departure and steam coming out of the year-end rally taking a toll. Plus, coffee futures hit a 47-year high, doubling year over year. Speculation on the impact of weather on Brazil's crop is pushing up Arabica coffee prices and its cheaper alternative, Robusta beans from Vietnam. Coffee producers are already adjusting prices. And that's your Yahoo Finance Market Minute to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below. More wealth when we return.
The Fed is expected to cut rates for a third time this year with 88% probability of a 25 basis point reduction at the December FOMC meeting. One of the effects of falling interest rates is typically declining rates on credit cards, and that's because most cards use variable rates that track the Fed's benchmark rate. However, according to LendingTree, the average APR on a new retail credit card is 31%, with some as high as 34%, and the average APR overall is just around 24.5%. So, why are these store card APRs so high? Joining me now on set, we've got Matt Schultz, who is the LendingTree Chief Credit Analyst. Matt, let's start there. Why are the store card APRs so high right now?
Well, they're high because there's a lot of risk involved in it for the card issuers, and these stores want to be able to give these cards to anybody who walks up to the checkout counter. And when that's the case, you're basically taking on a bunch of risk, and whenever there's a bunch of risk, one of the things banks do is raise interest rates on the cards. So that's where we are.
It seems like once we hit January, there's going to be a bevy of announcements, or at least social media posts that come out from who is now the president-elect, and at that point we'll have what seems like Congress in his favor, and with the red sweep that we had seen, all these things considered, a credit card rate cap has really been talked about, and it seems like it's accelerating in thought process here. What's the likelihood of this becoming reality?
It's still a really, really long shot. Even though President-elect Trump supports it, even though people like Bernie Sanders and AOC and Josh Hawley in Missouri have all talked about rate caps in the past. So there's a bipartisan thing happening. But there are just so many people and so many moneyed interests who are going to do everything they can to keep that rate cap from coming. And it's a long shot at 18% or 20%. At 10%, like President Trump talked about, it's a non-starter, honestly.
Yeah. So all these things considered, the landscape right now, 3 in 10 Americans are somewhat likely to apply for a store card this year. What is the kind of delta that you've seen versus last year, and what is the outlook projection going into 2025?
Yeah, people are a little more likely to say this year that they'd apply for those store cards, and that's even, like you said, with the rates being 31% or higher. And some of that is just that people are looking for anything they can do to save and to extend their holiday budget, because those cards sometimes come with 15-20% discounts, and that's significant. They can be a good tool if you pay it off in time, but that's often not necessarily possible.
You know, would love some tips that you have for cardholders out there, especially in a peak shopping season here, as many people are trying to figure out how to smart spend, but also how to begin paying down some of the debt as well that they're taking on here.
Yeah, really one of the best things you can do with card debt, and really any type of debt, is get your interest rates under control. Yeah. And if you're waiting for the Fed to come in as the cavalry, you're going to be disappointed. But if you can get a 0% balance transfer credit card or a low interest personal loan, that can be really good. Something that people don't necessarily know about as well is that you can call your credit card issuer and ask for a lower rate. About 3 out of every 4 people who did that in the past year were successful, and the reduction can be really significant. So that's a really important step to take too.
Store cards versus buy now, pay later. What is the thought process around that?
Well, we found in our latest survey that store cards are still a little more popular than buy now, pay later, which is interesting because that kind of goes against what the trends have been for the last couple of years. And both of them can be great. They're just very different. With buy now, pay later, the difficulty is that they are so easy to get that you can get too many of them and get a little bit out of control. So that's certainly something to watch.
Matt Schultz, thanks so much for taking the time here with us on set. Appreciate
Thank you.
it. Well, buy now, pay later continues to gain some popularity. It's expected to account for $18.5 billion in spending this holiday season, 2024. That's according to Adobe Analytics. Here with some insight into current buy now, pay later trends is Kevin King. He's the Vice President of Credit Risk at LexisNexis Risk Solutions. Great to have you here with us. And so, as we're just evaluating some of these stats and the spending here, What does this really hold for the mentality of the consumer from your own read through right now?
Well, that's a good question. I think it's the answer is that maybe changing the way consumers are thinking about credit, right? Because it's creating more affordable rates and terms for individual retail purchases. But I think Matt just made a really good point a moment ago. It's also something that may be doing some harm in terms of encouraging unsustainable purchasing habits and allowing consumers, if they're not managing how they use these loans carefully, to get in over their head very quickly.
And so how do you expect that, especially coming off of a holiday season where consumers have already been regarded by many of the retailers as looking for promotions, looking for discounts, and ultimately looking to perhaps put some of their rewards into play as well, when we get into next year where buy now, pay later could either take a back seat, or ultimately you look at a consumer that says, I just don't need to tap into this experience as much anymore because I am being more judicious about my spending?
We see actually maybe a different set of behaviors, Brad, already into the holiday season. LexisNexis Risk Solutions monitored this past November relative to November 2023. We saw a 20% increase in buy now, pay later use, and that increase really started spiking maybe a week or two earlier than Black Friday and kind of that traditional kickoff of the retail season. And that growth, Brad, according to our research, is not driven by new consumers who are trying this out for the first time. 94% of those buy now, pay later loans came from existing customers that already used the service, but wanted to find more and more ways to leverage that financial tool. So I don't know if I see the appeal broadening, but it's clear that once consumers develop an affinity and a familiarity with these tools, they're using them again and again, retail season or not.
So further entrenchment among an existing user base is something that you're tracking, it sounds like. So with that in mind, has the type of purchase that people are expanding their use of buy now, pay later for, has that changed materially, or is it the same type of classification or product that you're noticing right now?
A great question, and I would say it's changing materially. If we cast our minds back to maybe 2020, when buy now, pay later use in the US was kind of first entering our consciousness, we thought of this as a tool that was being used to finance home gym equipment, right? Luxury retail goods, and that's still part of the story. But we're seeing more and more consumers use these tools for essential goods like groceries. 18 and 19% of transactions in 2023 started to skew there. And essential services like auto repair, for example, is something that's becoming increasingly leveraged by buy now, pay later users.
So with that in mind here, and this might be coming a little bit back to the question that we had brought up in our previous conversation, and to start off our conversation a little bit, what does that actually mean that the health of the consumer sits at right now? I mean, we're going to get a data print this week, and CPI, we'll get retail sales as well next week, and the Fed's really going to have to put together their own assessment among the health and really try to encapsulate the health of the consumer going into 2025. What does that look like from your own assessment if you do have this many consumers that are using BNPL for even groceries right now?
There are areas of buy now, pay later use, which I think can be actually very responsible for some consumers. It'll be interesting to see how some of those bodies view it, right? Generally, we're talking about lower interest rate loans. If you're a parent who's buying an expensive gift for their kid for the holidays, if your only alternative was maybe a subprime loan, well, this is maybe a really big win. Even some of those APRs Matt covered with retail cards, we're talking about things that are much, much lower. The key is, are you using this to finance 1, 2, 3 purchases a month, and you're tightly tracking each one of those loans when they're going to take the money out of your checking account? Or you start getting addicted to the experience of easy access to credit, and you get yourself in over your head. We know consumer household debt is on the rise. We know delinquencies are on the rise. It's going to be interesting to see how this user base starts handling subsequent or concurrent maybe buy now, pay later loans. Can they manage that burden, or do we start seeing it further accelerate the pace of delinquencies in the US?
Just lastly, while we have you here, Kevin, just want to give people some actionable advice here as they're doing some of that shopping this holiday season. What is the decision tree for safe buy now, pay later actions that consumers may be taking?
Yeah, really, really good question, Brad. I would say this. if you have a couple of large purchases, and that could be essential purchase or it could be retail, that you would have made with your normal credit tools, that might be easier to handle broken up into a couple of installments. Buy now, pay later makes sense, but you need to track exactly when those payments are going to get taken out of your checking account, who you've taken out the loans with, and you're overall keeping an eye on the total debt amount so you don't get out of control, right? So long as you keep things tightly managed here, if your interest rates look like some of what we just saw on those store cards, a no to low interest rate product with low late fees might look very, very attractive.
Kevin King of LexisNexis, thanks so much for taking the time.
It was a pleasure. Take care.
Likewise. Coming up, everyone, the one simple change that households can make that could slash the racial wealth gap by double digits. Plus, if you're looking for a job in 2025, we're telling you what you need to find a great opportunity. All that and much more coming up. According to the Federal Reserve Bank of St. Louis, Black American households own 23 cents for every dollar owned by white households. A new study shows how one simple change could decrease the racial wealth gap by double digits. Here to break it down, we've got Yahoo Finance's very own Jana Heron. Hey, Jana.
Hi, Brad. How are you doing?
Doing well, doing well. Thank you. What do we know from this information released by the Federal Reserve Bank of St. Louis?
So the recent research found that if Black Americans, especially homeowners, wrote wills at the same rate as white Americans, that would shrink the racial wealth gap by 10% over 3 generations. But the problem is right now about 70% of Black homeowners who are over 50 and also have children don't have a will versus 36% of white homeowners. So taking that crucial step, estate planning step, would preserve that wealth.
What are some of the ways that households can lose wealth then without a will? Because it sounds like that's the major issue here too.
It really is. So it really comes down to how your state's process of designating heirs. So these laws apply when you die without a will, and they dictate who your assets are distributed to, regardless of how you would want that to happen. So in many cases, if there are multiple people who are entitled to your assets, such as, there's several children, land or property are divided up in an ownership structure that has historically put these properties at risk. So let me break this down. So if I and my two siblings inherited our family home, it would not be that each of us owns 1/3. And what would happen under these states' laws is we have an ownership right to the entire home. So that means I could go out and get a loan against the property without the permission from my brother and my sister. Or I could go and sell my ownership stake without their permission. And that's where the problems occur. Because many developers buy one of these ownership stakes from Black families especially, and then they take the other remaining owners to court to force a sale of the property, usually below market rate. So not only have the people who've inherited this property lost the property, but they also didn't receive the full value of it. Almost half of states have put in rules to try to mitigate this scenario from happening, but it's not foolproof. And that's where a will can come in and you can designate who gets the home. So maybe you give it to the child that you know is not going to go sell it.
And so what programs are mobilizing more households of color to have a will in place?
So in general, most people don't like thinking about this because it is very uncomfortable. Who likes to think about their own death? And I think there's also an idea that this is for rich people only. And for communities of color in particular, there's a long-standing distrust of financial services industry, stemming from redlining and other discriminatory practices that we've seen in the last 100 years. And there's also a lack of representation among financial planners and attorneys. So there's not as many financial planners of color. So there's not that trust there. And of course, cost for all of us is a huge factor. I know this from personal experience because I just went through it this year. So if we were able to do more pro bono events in community settings where people of color are, whether that's at a minority-owned bank or even at the local library, that might work.
Jana, excellent breakdown here. Some really timely information. Appreciate it. Thanks.
Thank you.
Unemployment remains at historic lows, but it did tick up during 2024. Joining me now for a look at the 2025 labor market, we've got Corey Staley, Indeed Hiring Lab economist. Corey, good to see you here. Let's start with the biggest takeaways from Indeed's 2025 U.S. jobs hiring trends report. And you say that unemployment and hiring need to remain stable. Why is that?
Yeah, good morning, Brad. So, I mean, really what we see as far as these numbers and why we think those need to remain stable is for years now, we've talked about the potential for a soft landing. And we've kind of gotten to a point where we're on the glide path for this soft landing. But as we look towards 2025, we're actually seeing, a pretty decent likelihood that we could potentially make that soft landing if some things go right. So at the high level, we think that part of what needs to go right in 2025 is we need to see hiring stay at least stable, potentially pick up, because right now it's pretty low. We also need to see unemployment and layoffs staying low as well, because if we start to see those things rise, even if inflation starts coming down even closer to the Fed's target, then we jeopardize the soft landing there as well. But I think also as we look towards 2025, there's some other things that we're keeping an eye on around labor supply. We're seeing some potential risks on the side of immigration and aging populations. But then we're also watching kind of a growing trend in flexibility that we're seeing more employers prioritizing skills in job postings. And we're still seeing a lot of demand from workers for remote work and hybrid type of opportunities.
You also found that employers will need to do more with less. Break that down, and how is that?
Yeah, so I mean, I think as we look at it, again, this comes back to this idea of, we have a very aging population. If you think about the pool of workers, as a literal pool or a literal pond, we're at a point now where in 2025, we're starting to see, in the last few years, we've started to see, all of these people leaving the labor force, fewer people coming into the labor force. And what that means is that as employers are looking for people, that pool of overall workers is shrinking, and it's supposed to continue shrinking, but we're starting to see, even in 2025, we're seeing things like labor force participation start to level off. We're seeing potential for immigration to have a major impact on the labor market next year, especially depending on actions taken by the new administration. And that could really put a lot of pressure on businesses if they can't find people to fill the jobs while they're trying to grow and trying to bring more people in. So doing more is really about trying to find out, can you use Gen AI to maybe enhance productivity? What can you do to hold on to your existing workers in some of those potential challenges that employers will face in 2025?
And what advice do you have for job seekers who want to stand out next year?
So I think there's always, kind of the good old classic advice of, making sure you're tailoring your resume, right? Making sure your resume matches the jobs. Anymore, we live in this world where when you apply for a job, especially if you're using online job boards, you end up having your resume pass through what's called an applicant tracking system. And that's basically just recruiter speak for a piece of software that takes your resume, runs it through, and checks to see if you have the skills in the job posting. So as a job seeker, sitting down, making sure the skills in your resume match the skills that are being asked for in that job posting is key. But I think beyond that as well, there's also a lot that job seekers can do in terms of really focusing on prioritizing skills. We've seen that employers are asking for formal education requirements less. They're asking for less experience over the last few years as well. Employers are becoming a little more flexible in their hiring. So as a job seeker, you can prioritize skills and then even look at developing skills, new skills around things like generative AI, and really think long term. So I think, just overall developing skills, and then also just the old classics of tailoring your resume and practicing for interviews.
Corey, thanks so much for taking the time and breaking down some of these tips going into 2025. I appreciate it.
Thank you.
Let's do a final check of the markets here as we're taking a look at the major averages. The Dow, the S&P 500, and the NASDAQ are all in positive territory just by the hair of the chinny chin chin here. We'll see if we can hold on to that into the close. That's it for Wealth, everyone. I'm Brad Smith. Thanks so much for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. They'll count you down to and through the market close.